that short distance down the tube, that in popular imagination, Hyperloop became a mode of transport.
The metaphor I use with my team is that, the Wright brothers were first, but none of us fly on Wright Brothers Airlines anymore. If you don't continue to innovate, you're not going to be around, and so we'll continue to be at the forefront of building Hyperloop.
Back in 2013, Elon had an idea. I think the difference now in 2021 is some brilliant engineers have spent real time grinding out the details. And I thoroughly expect the next 3 to 5 years to be decisive.
This week, how hydrogen can transform our energy usage. We'll look at why the universe's most abundant element could be a game changer in the climate revolution.
Hydrogen technologies are not new. They are used in other sectors. We use them in space, on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes.
From iron ore to green hydrogen, one of Australia's richest men tells us about his pivot to sustainable energy.
Let's take action. It's practical, it's implementable. Let's do it now.
Plus, the hydrogen revolution. We'll speak with the CEO of Italian utilities firm Snam about his new book and how green hydrogen could be competitive within 5 years.
Costs are coming down and people are waking up to the fact that it's the only way to decarbonize certain sectors.
From Bloomberg's global headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. It's a new year, so here at Bloomberg Green, we're highlighting new solutions in the fight against climate change. And one of those is as old as the universe itself, hydrogen. It's the simplest element around, but could well be a game changer when it comes to turning around our dependence on fossil fuels. Today, hydrogen is used in the chemicals industry to produce petroleum products. It's also starting to be used in steel production, an industry under a lot of pressure to decarbonize. But it has far more uses as well, from powering cars to heating our homes. And Bloomberg New Energy Finance sees a seismic shift in the sector in the next 10 years as green hydrogen squeezes out dirtier alternatives. So-called gray hydrogen dominates today. But as renewable electricity gets cheaper and more accessible, so will green hydrogen. In this week's edition of Bloomberg Green, we'll explore what this push into hydrogen means for tackling climate change. We'll hear from Australian billionaire Twiggy Forrest about his pivot from iron ore to hydrogen, and we'll also speak with the CEO of Italian utility company Snam about his book, The Hydrogen Revolution. But first, what are we using hydrogen for? And why does it actually matter? Christine Lee Edwards explains.
Hydrogen, the most plentiful element in the universe. On Earth, we find it mostly bonded to oxygen in the form of water, or in other gases known as hydrocarbons. Hydrogen gas, H2, burns hot and clean, making it an attractive tool in the race to net zero. But isolating hydrogen from other elements is no easy task. Today, the cheapest way to do this is via chemical processes that break up natural gas. This releases a lot of carbon dioxide. Another method is to use electricity to split water molecules in a process called electrolysis. Although there is no carbon byproduct, a lot of electricity is needed. And if this power comes from burning coal or gas, it negates the zero emissions goals of using hydrogen to begin with. Hydrogen produced in this way, powered by fossil fuels, is called gray hydrogen. If carbon capture and storage is used together with fossil fuels, then it becomes blue hydrogen. If nuclear power is used, it's called pink. And finally, green hydrogen is when it's produced via electrolysis and powered from renewable sources. This method is considered emissions-free. It's predicted that by the early 2030s, H2 made from renewables will be cheaper than that made from fossil fuels. But that hinges on the cost of electrolysis declining, which will be achieved through larger projects and an expansion of manufacturing. To be clear, vast amounts of H2 are already used today. Global production in 2018 totaled 117 million metric tons. This hydrogen is mostly used for its chemical properties, not as a source of energy, and very little of it is clean. Some sectors like steel could start using hydrogen for these chemical properties, replacing coal. Industries like cement and glass may also use hydrogen as a source of heat. Another advantage is its energy storage potential. It can be stored over long periods of time and used when more power needs to be added to the grid. It also could hold an advantage over batteries in heavy transport and shipping. The promise of hydrogen for energy has been around since at least 1874, when Jules Verne wrote about it in his book, The Mysterious Island. But the future of hydrogen will depend on policy. Countries with net zero targets, carbon pricing, and hydrogen strategies with investment mechanisms are likely to see the highest H2 demand.
That was Bloomberg's Christine Lee Edwards explaining what hydrogen means for the energy transition. But how are businesses approaching the sector? Well, one of Australia's richest men is making a big play into hydrogen. Andrew Forrest, better known as Twiggy, made his fortune from iron ore, being the chairman, former CEO, and major shareholder in Fortescue Metals, one of the world's biggest miners. But after having made over $10 billion in profit from the metal in the last fiscal year, Twiggy wants to transform Fortescue into a clean energy company. He's been scouring the planet in search of investment opportunities in hydrogen and renewables. The firm plans to allocate up to 10% of its annual profits for green energy investments and is exploring projects across the globe, from Indonesia to Argentina. Francine Lacqua caught up with Twiggy Forrest.
There's only one type of clean hydrogen, all the rest is dirty.
Yeah.
That is green. If you just say green hydrogen is clean, the rest is dirty, then you've actually nailed it. And, you know, anyone else who produces any other rubbish, any other argument, just look them in the eye and say, why is global warming accelerating if anything you're saying is true? And then you'll know, actually, it's greenwashing.
Yeah, but there's a lot of greenwashing because I keep on being told it's a transition. We can't just, make the transition at a click of a finger. So what are we doing wrong? What can we do better?
I don't remember the personal computer having to transition the typewriter. I really don't remember that. I don't remember the smartphone having to transition the pocket calculator and the old landline. You know, its transition line is complete rubbish. The lie got put to it 2 days ago when JCB, a really loved British company, every right for the country to be proud of JCB, and Fortescue, holding a bit of a similar reputation, fantastic track record, everything from Super Bowl from Fortescue, huge balance sheet, super strong, when those two companies got together and agreed a $7 to $9 billion US agreement per annum, right, then that's a real wake-up call to say, hang on, green hydrogen is obviously commercial now. You know, every other form of fossil fuel hydrogen, you know, it can compete with it on price. It can probably lose on price, but what we know, it is cooking the planet. And only green hydrogen, zero methane, zero carbon in the supply chain. Don't worry about the molecules in the supply chain.
But at the moment, we're not even phasing out coal, if you look at the G20 communique. So we have a long way to go to talk about only using green hydrogen.
Yeah, so look, I have a call, which I'd like to make now, that the world should not fund any more coal-fired power stations, coal mining projects, ever. We should wind them down as quickly as possible because they are cooking the planet just like grey and blue hydrogen is cooking the planet.
Yeah.
You know, hydrogen, which is not made from renewable electricity, is releasing 10 to 16 times more carbon, let alone the methane, which is worse, than it is hydrogen. So we've just got to stop doing things which are self-harming under the guise of greenwashing.
So why are leaders so slow? Even if you look at the appetite for ESG investments, they're growing exponentially, so are emissions. So where are we allocating capital?
Okay, so take the recent G20. There's probably a reason why there wasn't strong action coming out of the G20 because people were not aware that major transactions between large companies were taking place now on green hydrogen, that actually this pollution-free all the way through the supply chain fuel is now being transacted at multi-billion-dollar scale. If they'd known that, I don't believe any sovereign leader or any energy minister or climate change minister could not take ultra seriously that green hydrogen is now here to stay. It's broken through. History has been made. It will never go back.
Okay, what is the one thing that you would tell leaders today and business leaders? How do we transition faster than what we are now because we're at real risk of missing our targets?
Oh, so that's really simple. You stop funding, you stop subsidizing, you stop using money into fossil fuels. It could be carbon sequestration, it could be fuel rebates, it could be anything. Hundreds of billions of dollars getting ashed while we ash the planet on fossil fuel subsidies. Because we haven't had that renewable electricity, we haven't had that green hydrogen, we've kind of been pushed down. It's all sorts of excuses. Oh, it'll never be commercial. It'll never be supplied in the quantities we need it.
Connection lost.
Now we know, let's take action. It's practical, it's implementable. Let's do it now.
Okay, if we do it now, is there going to be a shock to the energy system? Is there going to be a shock actually to economically? And is it worth, you know, not talking about transition, just going from A to B?
Yeah, it's a fantastic question. A to B is the solution. Let fossil fuels do what fossil fuels do. Just burn their coal, burn their oil, burn the gas. At least they're pumping up carbon and methane into the atmosphere, honestly. Well, not that honest because they don't measure methane, which is 90 times worse than carbon. But at least the carbon is being done honestly. Encourage the green hydrogen sector to come in really fast. Okay, it's there. There's renewable power all over the world. We now know how to make electrolyzers much cheaper, like 25% of the original cost. We know how to do that now. We don't have an excuse to get into it.
Does it need to be cheaper than oil and fossil fuel for it to be viable worldwide?
Well, right now it is. Okay, so let's just swallow that bit of financial data. Right now it is cheaper, and it's getting more cheap. It's the only fuel you know of which is declining in value.
You don't have enough of it, right, to power the world?
Yes. That's only because we haven't had policies to support it. If we had policies to support it 5-10 years ago, it would be everywhere. You'd see the global warming budget start to come down. Now, we've got 5 or 10 years to make a huge difference. I need policy leaders all over the world to appreciate now, okay, big business is transacting with green hydrogen in multi-billion-dollar agreements. We now know it's here and it's here to stay. Let's spread it everywhere.
Coming up on the program, the hydrogen revolution. We'll speak with the CEO of Italian utility firm Snam about his new book and why he thinks green hydrogen will be competitive in just 5 years. Plus, how are airlines working to become more sustainable? We'll look at how Airbus plans to step up in the climate fight. This is Bloomberg Green. From Bloomberg's world headquarters in New York, I'm Kaylee Lines, and this is Bloomberg Green. What will the world look like in 2050? Will global temperatures have stabilized, electric vehicles be abundant, and solar and wind power homes around the world? According to Marco Alvera, the CEO of Italian energy company Snam, that vision of the future could be a reality. And he says that hydrogen will pave its way. As he tells it in his new book, The Hydrogen Revolution, Alvera's moment of reckoning came in November 2018 when he tasked the Snam Scenarios team with studying how Europe could reduce its CO2 emissions to zero by 2050. Looking through the results of the study, Alvera said he was struck by how much hydrogen was in Europe's energy mix by that year. Beyond the abundance of hydrogen, the Snam model also predicted that it would be the cheapest form of decarbonized energy for many sectors, and that it could be cheaper than today's prices for oil, coal, and nuclear power. Our Maria Tadeo spoke with Alvera at COP26.
It's happening all very fast. We see the cost of hydrogen coming down a lot. Hydrogen will play a big role in the energy mix. I don't know if it's going to be 15 or 25% of a fully decarbonized energy system, but it's going to be big. Costs are coming down, and people are waking up to the fact that it's the only way to decarbonize certain sectors, so-called hard-to-abate sectors.
And you say it's the only way and the costs are coming down. Where do you see prices moving? Because a lot of the reticence at times has to do with the pricing, that some argue, well, it's still not the cheapest option on the market.
So when I was first working in hydrogen in 2004, it was costing $1,000 per megawatt hour. 2010, $600. Today, $100, and we see it going down to $50 in 5 years' time, and to going down to $25 per megawatt hour in the next 10 years or so, which is a quarter of where it is today. That's really because renewable energy, and we're talking green hydrogen here, renewable energy costs are falling, but the cost of making the electrolyzer, which is the kit that you use to convert solar or wind energy and water into hydrogen, the cost of this kit is falling a lot because it doesn't really exist on an industrial scale. So as we build up capacity, we industrialize it, we standardize it, and we squeeze costs out. That's really the cost trajectory.
And for that, of course, you need demand, however, for governments and also institutions to kind of buy into this idea that it is the future and we want to invest and create infrastructure. What are they telling you? When you speak to governments, when you speak to officials, are they keen on this?
They're very keen. So the Department of Energy shares our view in the States of getting to below $1 a kilo, which is $25 a megawatt hour. The European Union has a hydrogen strategy, which is very clear, and several member states have the same. Chile wants to export a lot of hydrogen. China's big on hydrogen. Australia's very big on hydrogen. Japan is blending already hydrogen. So I would say the world is now really focused on this because it's the only way to store energy for a long period of time economically is to convert it into either a liquid or a gas.
And of course, you talk about the price, but the other big component is the volume. You know, how big can you go? Where do you see that on a time scale?
So wherever it's sunny or windy, you can produce very cheap hydrogen eventually. And so compared to oil and gas, which are concentrated in few parts of the world, it's going to be very democratic from that point of view. So every sunny place, every desert, every ocean wind can be turned into hydrogen that we can put on ships, in pipes, and really start trading it around the world. So it's going to happen a lot faster than a lot of people think.
So, and when you say a lot faster, what is that in time?
As I said, $50, which is essentially oil parity within 5 years. And then, depending on how quickly we ramp it up after that, we could get to $25, which is coal parity before the end of the decade.
And in big scale.
In big scale, because once you get to coal parity, that's the only way we're going to get China and India to stop burning new coal. We have businesses in China and in India, and I see a lot of hydrogen development, a lot of renewable development in both countries. The India announcement was incredibly strong on 2030. Some people were upset about the 2017 net zero deadline, but when it comes to 30, he announced a big commitment to get to 50% renewables.
Were you surprised by it?
I was surprised that they would make it so explicit, and even the net zero is a big thing for them. And so I think it will happen faster than 2070 because of the falling cost of renewable and hydrogen. India's burning 80 gigawatt of oil, of diesel, to keep the lights on. So there's an immediate opportunity there, and we're very interested in working in that country.
And with regards to China, perhaps the fact that we haven't really seen them active, I guess the diplomats are working on this, but we haven't really seen the leadership.
It's going to be technology, it's going to be industry. I think China has committed to a net zero, which is very important. At the G20, China was clearly behind the 1.5 degrees. So I think a lot has been achieved between the G20 and COP, and I think what's really important is to see in the coming years how quick it's in our hands to make part of this happen in 5 years, or it could otherwise happen in 15, 20 years. It's about building the project. The capital is there. We saw how many trillions of dollars are already committed. What's missing is really the projects, and that's where companies like us step in.
Marco Alvera, CEO of SNAM there, speaking with our Maria Tadeo. Let's turn now to the aviation industry. It's a big contributor to global greenhouse gas emissions, and it's under pressure to change that. In October, the International Air Transport Association, a trade body representing airlines, approved a target of achieving net zero emissions by 2050. To achieve that, many airlines in the US and Europe are looking to buy sustainable aviation fuel made from renewable sources like used vegetable oil. Initiatives like these are pushing plane makers to come up with some radical new aircraft that will eventually cater to our growing appetite for travel without hurting the environment. We took a look at how Airbus, the world's #2 aircraft manufacturer, is stepping up to the challenge.
How long until we can fly emission-free? Airbus says it's more confident by the day it can be done by its 2035 target. Airbus's CEO spoke about its ambitions for hydrogen-powered planes at the company's summit in France.
The physics works. Hydrogen technologies are not new. They are used in other sectors. We use them in space on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes. So every day we become more confident, but we think we need to have a plane, we need to have the right fuels, the hydrogen available in the right quantity at the right place at the right time, and we need the regulations to be ready. So we really need the work and the collaboration of many people around the globe to make it happen on time.
But it could be a long wait until green passenger jets go mainstream. Larger aircraft with more than 150 seats are not expected to feature globally until about 2050. That means manufacturers and airlines today are under growing pressure to ramp up short-term innovations to cut their carbon. In the long term, meeting the ambitious plans for so-called green hydrogen means building a giant industry almost from scratch. To make that happen, British airline EasyJet is among those saying governments need to get involved and fast. Aviation's emissions over the last 3 decades leading up to the pandemic grew by about 80% to over 1 gigaton, and that's projected to double by 2050. According to Bloomberg NEF, about half of the airlines with the largest global market share have set net zero targets by that same date, nearly 3 decades away.
Coming up, from blue sky projects to the bottom line, We'll speak with our Bloomberg NEF expert, Meredith Annex, and dig into their models about how hydrogen fits into the future energy mix. This is Bloomberg Green. From Bloomberg's world headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. Now let's bring in Meredith Annex, our Bloomberg NEF hydrogen specialist, to talk more about how hydrogen could change the energy landscape. So Meredith, what place do you think hydrogen is likely to have in the future energy mix globally?
Hydrogen's this incredible solution for us as we look to decarbonize because it's a perfect solution in areas that are hard to electrify. So where we like to think about hydrogen playing a role, it's in things like heavy industry, especially where you need a feedstock as well as energy source, and in things like dispatchable power, long-haul transport, maybe even shipping and aviation.
That sounds great that it can be used for such diverse industries. At the end of the day, though, how much is this going to cost?
Well, that's the amazing thing about hydrogen, because depending on how you make it, it can actually see significant cost declines in the future. So when we're talking about clean hydrogen, we usually mean green hydrogen produced from renewable electricity. And in that case, your hydrogen is almost as cheap as the renewables that are used to make it. So if you're in a place with really good renewable resources, you'll be able to have cheaper hydrogen. But even in places with less good resources, we think that hydrogen can be cheaper than $1 per kilogram, which is the price of unabated hydrogen today, and around $8 per million BTUs for those who prefer to think in energy units. And that can be achieved anywhere in the world by 2050, we believe.
All right, so let's talk about kind of the pros and cons list. I don't know where cost fits into that, but what are the advantages to hydrogen over other renewables, and then what are the drawbacks?
Yeah, main advantage is the fact that hydrogen can serve roles that electrons struggle with. And that's things like seasonal storage, for instance, or just anything where you need storability, where electrons are harder to store, hydrogen is going to be easier. That also leads to a downside, though, because hydrogen is less energy dense than the usual things that we use for storable energy today, like coal or oil or natural gas. So you will need more volume of storage to handle the same amount of energy.
Let's talk about the viability as well and how it may differ in different geographies. What is your view on that?
Yeah, so for green hydrogen, again, from renewable electricity, really places with the best renewable resources, things like Latin America or the Middle East, even Southern Europe, have really, really good potential for producing hydrogen. And then when you're looking at blue hydrogen, which is produced from natural gas or coal with carbon capture and storage, we do see that becoming more expensive than green hydrogen in the future, especially as renewable electricity costs come down. But that can be a viable option in places like the US Gulf Coast or Russia, where you've got good geological storage for the carbon, as well as ample natural gas that's quite cheap.
All right, great breakdown. Thank you so much to our Meredith Annex, our Bloomberg NEF hydrogen specialist. And of course, you can get more from the Bloomberg NEF team on the terminal and online. And they've recently done a podcast called Hydrogen 101 as part of its Switched On series. So from iron ore titans pivoting to cleaner energy to talk of a hydrogen revolution, that's it from this week's edition of Bloomberg Green. We'll be back next week with a deep dive into the state of electric vehicles. And you can keep the conversation going by following us on YouTube, Instagram, and Twitter @Climate. I'm Kaylee Lyons from Bloomberg's World Headquarters in New York, and this is Bloomberg Green.
Headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Stocks have paired gains a day after the worst sell-off in more than 2 years as investors assess prospects for growth in a rate-hiking cycle aimed at taming potentially high inflation. We've got the S&P 500 index trading little change, but lower right now, down by about half a point. The Dow is down 62 points, down 0.2%, extending yesterday's slump when the Dow dropped 1,276 points. Nasdaq, though, holding on to a gain of 27 points, up by 0.2%. We do have the 10-year yielding 3.41%, the 2-year 3.78%. Spot gold down $4 the ounce to $16.97, a drop there of 0.3%. And we've got crude oil up 2.4%, $89.37 for a barrel of WTI. As for the equity market outlook, Wei Li is Global Chief Investment Strategist at BlackRock International.
Right now, obviously, markets are moving very, very quickly. Yesterday, very dramatic sell-off, but today bouncing back a little bit. We believe that actually more needs to be given back to properly reflect the fact that we should be looking at an earnings recession.
Yesterday's brutal sell-off in the aftermath of August's hotter-than-expected inflation print looked like the opportunity to Cathie Wood's ARK Investment Management. The firm bought 27 stocks across its 8 exchange-traded funds. According to data compiled by Bloomberg, the largest buy was Roku, which already was the third biggest holding in the firm's flagship $8 billion ARK Innovation ETF. Today, we're looking at ARK. It is up 1.4%. Roku shares down by 0.7%. Again, recapping, S&P now higher by half a point. Little change there. The Dow down 0.2. NASDAQ up 0.3. I'm Charlie Pellet. That is a Bloomberg Business Flash.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
And a very good afternoon, everyone. Live from the Bloomberg Interactive Broker Studio. Yes, we are streaming on YouTube. It is Wednesday, September 14, 2022. Carol Masser, along with my co-host Tim Stenovic. I was tired of vacation, so I thought I'd come back.
I think this is the first time we've been back together in the studio in like 3 weeks.
What's your name?
It's good to have you back, Carol.
Here?
Are you well rested? Are you relaxed?
I had a lot of vegging going on while I was. It was a little bit of a staycation because of the weather.
Nothing happened while you were gone.
Yeah, what happens? I go away and the market sells off.
Doesn't that happen every year?
Happens every year, so I'm not going to go away anymore. This is I'm going to do something for the bulls out there. Speaking of the market, stocks though continuing to bounce around, Tim.
Yeah, we're actually seeing the S&P 500 move into the red, but the Nasdaq is still up by 0.2%. Investors still trying to figure out what's going on with the Fed. They're getting hot and heavy when it comes to raising rates.
Yeah, that's the problem, right?
Yeah.
All right, in keeping with that, we're going to talk about how the looming U.S. rail strike may make inflation matters even worse. Sorry, everybody.
Yeah, $2 billion a day if that strike happens. It's just wild. Plus, Walmart and checking accounts, it's soon to be a thing.
Also, the haven for Chinese manufacturers.
There's a hint.
Yep.
Look south.
Yeah, exactly. Also, we've got the inside story of YouTube, how it upended everything.
And we also go beyond beer with the CMO at AB InBev. Bloomberg Business Week is brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with the solutions they need to grow a thriving business. Commonwealth, go where you grow. Visit commonwealth.com to learn more.
All right, let's get to it, and let's get to the Market Drivers Report. Let's set your Business Week agenda on this Happy Hump Day, Wednesday, as we said, September 14th, in our studio, Interactive Broker Studio. Kriti Gupta to my right, markets correspondent at Bloomberg, and to my left, Molly Smith, economics editor at Bloomberg News. It's almost like it's like a boxing match. To my right, to my left. No. We all get along. Exactly.
Oh, we'll see about that. We got 5 minutes to figure this out.
Anything can happen in our studio. All right, Kriti, let's kick it off with you. We are bouncing around in terms of direction. It doesn't feel like investors quite know what to do, and it makes sense after 4 days of gains and a massive sell-off yesterday.
Yeah, and I think, look, we're seeing the S&P 500 down about 0.2%, the Nasdaq almost flat on the day, and that's really just happened in, I want to say, the last 30 minutes of the market trade. For most of the session, we were actually higher on the day, but I wouldn't call it by much, only about 3 to 0.4%. And to me, when you see that follows, by the way, an almost 4% move in the Nasdaq down yesterday.
What's the volume?
I will check on your handy-dandy Bloomberg terminal. WEI is the function.
It's high.
Volume is actually up, and especially
really
on a 5-day basis. A lot of people like to look at a longer time frame.
Yeah.
But once again, that's normal because you have to think about stocks. I make this example. I think I've done it for the last 3 days with Tim on this show.
Go on.
But you have to treat it like a spring. When you see that kind of massive decline, well, it is going to kind of pop back up, and that's what the stock market is doing right now.
Individual investors. I know there's a story by our Bailey Lipschultz back in a big way.
Yeah, retail versus institutional is still a major story, but I also think you have to talk about with institutional clients, where's the money actually going? Because to me, I think more of the action is in the bond market right now because you have the 2-year yield that is moving crazily. Right now up only about 3 basis points, but still 15-year high for the 2-year yield.
Hey, Molly Smith, come on in here and let's talk a little
Seems
bit
like
about
a good segue to her.
eco data. Yeah, when she was in here, was it yesterday, Molly? That was
Time
yesterday.
flies.
Yeah. We ended with you giving us a little preview for what we had coming. PPI were the numbers to watch this morning. We did see that it showed that U.S. producer prices fell for a second month in August. But what's the bigger story here?
It's really just falling because gas is falling, which was to be expected, and the core measure accelerated. So very similar to what we saw with consumer prices. I wouldn't say, though, that this was quite as startling. I think, the consumer price index is really more, shows you like the breadth of categories that we experience in our everyday lives, and in the production pipeline, it's a little bit different. And probably the thing that for me was most surprising in the producer index this morning was that food prices were actually flat. So perhaps that's actually a good omen in the months to come for consumer prices, but really hard to tell still with the war in Ukraine ongoing.
Well, and that's the lag, right? Producer prices ultimately then show up in CPI, correct?
Correct. And to be clear, that producer prices for food have been rising a lot leading up to this report. So still any slowdown, and that will take a very long time to filter through.
I mean, I know Mark Mobius, our colleagues overseas, caught up with him, well-known investor, global investor, talking about the Fed maybe needing to go as high as we are seeing in terms of rates as to what we're seeing on inflation. Is that realistic? Do you guys have those conversations in terms of your expectations about how high the Fed has to go in order to really bring this down?
I mean, as far as next week goes, I think 75 still seems to be the clear preference. There are a few people who are calling for 100 basis points, but that seems to be more of an outlier than the realistic case. I think as far as credibility and messaging goes and not wanting to surprise markets, that's still very much more in like what Powell is trying to accomplish.
Yeah, Nomura yesterday calling for 100 basis points. Then on the other side, you have people like Cathie Wood and Elon Musk coming out and saying, actually 25 basis points is what
I love it when they get into it on social media.
I mean, you have to remember that Cathie Wood and Elon Musk have a lot of a big stake in, you could call them growth stocks. So low interest rates would be a pretty good thing for them.
Well, Jeffrey Gundlach said that as well.
I saw that yesterday.
So there is something going
surprising
on with rich people at 25 basis points, which is interesting because I think Vince is also quite contrarian on that front. Sorry, I just hijacked the conversation
Go for it.
here.
No, go.
But this is the case that a lot of people are making when it comes to 75 or 100 basis points. The idea that perhaps the Fed does actually need to go far more aggressively, but then what about the psychological effects of calling it 100 basis points? Because last time you did it, it was the 90s and people were panicking.
Let me tell you about the psychological effect when I check out at the supermarket or check out anywhere, because it just feels like everything's expensive. And we know for those at the lower end of the socioeconomic ladder, it's really difficult.
Yeah, I mean, look, we hear a lot about this idea of trading down. We're doing that in my household. Greek yogurt, out. We're getting back to the old yogurt.
We're going to talk to
It's like $11 for a thing of Greek yogurt.
Oh my God.
Yeah, that's insane.
Our dog has had a bad tummy and we've been feeding it chicken and rice. This sounds so pathetic, but it's like unbelievable, the cost.
I want to get sick at your house.
I know, exactly.
What would I eat? What does a human being eat when they're sick at your house?
I'm eating pasta. The dog is eating rice and chicken. All right, guys, we got to run. Lots going on. Thank you so much. Kriti Gupta, markets correspondent at Bloomberg. Molly Smith, economics editor at Bloomberg, both in our Interactive Brokers studio. I know. It's a crazy environment.
It is a crazy environment.
Speaking of, you said trading down, we're going to talk with the CMO of AB InBev, and I'm curious what they're seeing in consumers, whether they're trading down in terms of when it comes to beer and things of that ilk.
Yeah, I'm looking forward to that conversation toward the end of our program today. Let's go to Washington, D.C. now for a little world and national news. For that, we go to Nancy Lyons. Hey, Nance.
Thanks, Tim. Mourners are filing past the coffin of Queen Elizabeth II. She is now lying in state at Westminster Hall after a procession from Buckingham Palace. The Queen will lie in state for 4 days until the late monarch's funeral is Monday, with hundreds of thousands of people expected to file past her coffin. It is draped in the imperial standard with the imperial state crown sitting on a velvet pillow. In a statement, the White House says President Biden spoke with King Charles III today and expressed his condolences and his hope they will continue a close relationship. Back in Washington, the Biden administration is scrambling to avert a railroad strike that could snarl the supply chain and threaten Democrats in November. Bloomberg's Anne-Marie Hordern has more from the White House.
They need an agreement by Friday because this is not a good look for this president less than 2 months away from the midterm elections, especially as he said he wants to be the most pro-union president ever.
Bloomberg's Anne-Marie Hordern at the White House, where they're considering emergency powers to keep vital goods flowing. Railroads have already cut back shipments of hazardous materials ahead of Friday's deadline. The voting is open on which toys should go into the National Toy Hall of Fame this year. The class of 2022 finalists includes Bingo, Breyer Horses, Light Bright, Nerf Toys, the Spirograph, and plenty more. The voting closes on September 21st. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. This is Bloomberg.
All right, Nancy, thank you so much. Nancy Lyons in our 99.1 newsroom in Washington, D.C. You are listening and watching Bloomberg Business Week on this Wednesday. Carol Master along with Tim Stenovic. And one of the stories we wanted to bring to you, because we're going to be actually catching up with David Rubenstein. Is that tomorrow?
Tomorrow.
Yeah. who I'd love to
Is that
talk
right,
to.
Paul? Tomorrow
Is it
afternoon,
tomorrow?
right? Yeah,
Okay.
Paul's giving us a thumbs up. I got his new book at my desk, How to Invest.
Do you know it's such a popular book in the newsroom that Paul put it on my desk and somebody swiped it?
Can I just say...
I had to go swipe it from somebody else's desk.
I think in the close to 2 years I've been doing this, we've had 3 different books from David Rubenstein.
Rather prolific.
What have I done in that time?
What's great, well, you come in and you do a 3. It used to be a 4-hour show here.
Thank you,
and then
Carol.
you do Quick Take and you do a lot of other things. But yes, and what's great is he talks to a wide swath of people
Yeah.
that are out there, including in the investment space, and then is able to take a lot of those conversations, put them into incredible books, and then share them with the general public.
He's also weighing in on what investors should do right now
Mhm.
with the pullback that we've seen in recent weeks. Listen to this. He said that earlier today that it's actually a good time for investors to jump back into stocks, especially after the release of August inflation data triggered Tuesday's market plunge.
One man's sell-off is one man's
Makes a market,
buying
Carol.
opportunity. Here's what he said. Really skilled investors, I think, are buying things now at the bottom of the market or close to the bottom of the market. He said this. He, I think, caught up with the surveillance team earlier today. When markets are in trouble, as they are now, you could argue now is probably a pretty good time to invest. I'm not taking an investment position, bullish, bearish, or otherwise, but what I would say is the market is certainly up from where it was several years ago, and it just continues to churn higher.
Yeah, but speaking of several years ago, just for context, yesterday's drop, the S&P 500 and the NASDAQ composite both tumbled the most in more than 2 years. So in one single day, that's how big yesterday's drop was. We're talking levels of the depths of the COVID pandemic.
But it had rallied for 4 days, so it basically just erased
Yeah,
the
exactly.
4-day gain. So we go back and forth, and many people predicted earlier this year that this is the kind of market you would see that will get a lot of movement, but maybe by year's end we'll have seen maybe a slight gain or a little movement. All right, you're listening and watching Bloomberg Business Week on Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Tape. This is a Bloomberg Business Flash.
Bloomberg World Headquarters, I'm Charlie Pellet. We begin with a developing story. California is suing Amazon.com, saying the company forces third-party merchants to agree to policies that lead to, quote, artificially high prices for consumers. The Dow, the S&P, they're both lower right now. NASDAQ higher by 12, up 0.1%. But the Dow Jones Industrial Average extending yesterday's losses, down 79 now, down 0.3%. S&P giving up earlier gains, down 3, down 0.1%. 10-year yield, 3.40%. The 2-year yield, 3.77%. Crude oil up 2%, 89.12 a barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Kickoff to the close. Bloomberg's comprehensive cross-platform coverage, bringing you insight on what to watch ahead of the U.S. market close, starts right now.
And a very good afternoon, everybody. Welcome to the Kickoff to the Close. I'm Carol Masser, along with my co-host Tim Stanovic. We are joined by our colleagues on television, Caroline Hyde, Taylor Riggs, and the one and only Romaine Bostic. Welcome back. I haven't had a chance to welcome you back.
And welcome back to you, Carol. We missed you. Where were you?
We missed you. Taking some time off, you know, that kind of thing. All right. Well, anyway.
We'll talk about it later.
Yeah, we will talk later. Let's talk about what's going on in the markets, because we're seeing a lot of bouncing around, just like you've seen different anchors in and out when it comes to Kickoff to the Close. Well, we're all back as a team, but the markets bouncing around. We're off our highs, definitely, of the session. A little bit of a mixed trade, but really slight moves. If you take a look at the S&P 500, just down 2 points. The Dow Jones Industrial Average down 0.2%, 64 points to the downside. NASDAQ holding on to a slight gain, just up about 19 points. And if we take a look at the Russell 2000, it is down, Taylor, just a hair, down about 0.1%. Investors just kind of struggling with concerns about another hot inflation print.
A little bit calmer today than we were yesterday,
Yes.
certainly. Carol, I love that you sort of take us through these big equity markets. I'm going to really kick us off to some of the key things we're watching as we count you down to that closing bell. For me, as always, some of the big economic data, PPI report, of course, this morning to really kick us off. What I love about this chart on a normalized basis is we've talked about the huge inflation of CPI, the even bigger rebound of PPI, but I do wonder if that gap, of course, is closing on the right hand of the screen. We got PPI this morning, remain, of course, final demand month over month falling 0.1%, but there were some other statistics within PPI that are still rising. So I do think the jury is still out when we're really thinking about the big inflationary pressures underway.
And the inflationary pressures, and when you look at that chart and sort of that differential here, of course, we know a big part of that differential is that, well, a lot of these companies were able to pass those costs on, and the big question going forward, guys, I guess, is are they going to have that same pricing power over the next couple of quarters?
Well, another question, too, Romaine, is whether or not individual investors are going to come back into the market. We saw them come in a big way earlier today. Our Bailey Lipschultz out with a great piece and talking about retail investors in particular coming in, buying up the S&P 500 ETFs. Also, Apple shares some $2 billion coming into the market, the year's second largest day of retail net flows. Having said that, Sam Stovall, who's chief investment strategist over at CFRA Research, he wasn't surprised about the bounce back that we saw earlier in stocks, but says for investors, get ready for markets to tread water, at least for a bit. Check it out.
History tells us that whenever we have had a 4% one-day decline, that we usually see a bounce of about 1% the day after. That's happened about 2 out of every 3 times. But then we sort of trade sideways for the next week as well as the next month before resuming an uptrend 3 months down the road. So basically, you know, I think investors just have to hold on to their hats right now.
Yeah, it's kind of been a year where they have to hold on to their hats. That's Sam Stovall over at CFRA Research, Taylor.
And Caroline, this actually kind of folds into conversations you and I have been having, because on that note, dip buyers, the retail investor, they were buying yesterday. Vanda Research saying the second largest dip buying from the retail investor class yesterday, seeing that as an opportunity.
Yeah, and let's talk about opportunities that we see at the moment, the changing up of things as markets and indeed governments try to step in to ease some of this inflationary pressure that we continue to see in Europe. Of course, inflation thick and fast. We see natural gas prices pushing up once again. Look at these big moves, up more than 8%. Even as the EU, European Commission, Ursula von der Leyen, really trying to come out and say, look, we are there. We are going to be reducing your price point if you're a company using energy, if indeed you're a consumer at the moment. But how? you tax the companies, the energy companies that make so much profit out of it. 140 billion she hopes to be raising through that. But also there's an eye and a focus on this trading of the market as well, really trying to ensure that the liquidity is there at the moment, Carol.
Yeah, it's interesting, Carolina, and it's fascinating to see some of the European officials specifically talking about increased rationing to deal with this energy crisis. And you do wonder, Tim, what it means maybe for alternative energy or things like nuclear energy going forward.
The energy discussion is a big part of the discussion when it comes to inflation and why we saw a little bit of an easing. But apart from that, a couple days in a row of hot inflation, that's starting to really eat into the way that CEOs have confidence about the economic outlook. Higher inflation and higher rates are starting to hit the confidence of CEOs. The Business Roundtable coming out with its CEO Economic Outlook Index reading for the third quarter, it slid by 11.4 points. Look at that. It's at its lowest place in 2 years right now. A reading above 50 does indicate expansion, but it's at a 2-year low, and that can mean less investment when it comes to CapEx, and also affect CEOs' decisions about who they're hiring and what they're spending money on.
We're actually going to be speaking with the CEO of Amgen, Bob Bradway. It's going to be an exclusive conversation, Romain, about that confidence he's still spending.
Yeah. Oh, but tomorrow morning, of course, we're going to get those retail sales numbers. And remember, we're looking for a little bit of a slowdown here. But remember, it hasn't fallen off the cliff. I mean, we've seen that rotation from goods to services and back again, and now back to services. Remember, services won't actually be reflected in tomorrow's numbers, at least not with the weight that you would want to see it here. But I think that's the big concern going forward here, is how resilient is that consumer spend, particularly when you're seeing the majority of their income gains being eaten away by inflation.
Yeah, absolutely, Romain. And you wonder what it means for things like a McDonald's. And I'm saying that because we've got a headline crossing the Bloomberg where the McDonald's CEO says the company sees 2023 as a challenging year. So you do wonder, Tim, ultimately, how this is going to play out among the consumer space.
Yeah, what's going to eat into margins with these higher supplier costs? And we're not even getting to a potential rail strike, too, later in the week.
Yeah. That's a lot for us all to deal with. Once again, nothing's quiet, guys. All right, we're going to come back, continue these conversations. Countdown to the close in just about 30 minutes time, live on radio, TV, and YouTube. And of course, don't miss Beyond the Bell. We're going to count you down to the market close on this Wednesday. Our team back at 4 p.m. Wall Street time.
You're listening to Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, you are listening and watching Bloomberg Business Week on this Wednesday. So much going on, and a week from now, we've got the next Fed meeting.
I'm still waiting for that 1% gain that Sam Stovall was talking about.
Well,
I'm not seeing that today. He said like 2 out of 3 times,
Sam,
right?
I got to say, I love Sam. He has seen so many different market cycles, looks at it from a technical basis, and so maybe the percentage is off. We did see a bounce earlier.
The day's not over.
The day's not over, and I feel like it's going to be the countdown to that Fed meeting that's going to make things even trickier. All right, you're listening and watching Bloomberg Business Week. Carol Masser, Tim Stenovic, and this is Bloomberg Radio.
Broadcasting live from the Bloomberg Interactive Brokers Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 1061 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
All right, just when you thought it couldn't get worse, it apparently can.
We're talking a railroad strike, potentially.
Yeah.
$2 billion a day is what it would cost.
Oh my gosh, that's real money.
Yeah, we're going to get into that in just a few minutes. First, though, Charlie Pellet, you got an update on the markets.
Indeed, we are trading mixed. Stocks are being whipsawed. You mentioned the railroads, though, Tim and Carol. We've got Union Pacific down now by 3.6%. CSX lower by 1.4%. And Norfolk Southern is trading lower by 2.1%. We've got more on that potential strike coming up in just a moment right here on Bloomberg Business Week. Equities trading mixed. We've got the S&P swinging between gains and losses, back in the green right now, up by 3 points. A little change, though, up 0.1%. Yesterday, of course, we had the Dow plunging 1,276 points, down 3.9%. Down again today. Right now, we have got the Dow lower by 27 points, down by about 0.1%. NASDAQ up 42, higher by 0.4%. Spot gold down 0.3%, 16.97 the ounce, while West Texas Intermediate crude up now by 1.4%, 88.53 a barrel on WTI. 10-year, 3.41%. The crucial 2-year, 3.77%. As for the outlook for the market and the Federal Reserve, Oksana Aronoff is head of market strategy at J.P. Morgan Investment Management.
I will tell you one thing. I take a lot of issue with what the market is pricing in for next year, which is nothing other than the Fed making a U-turn and becoming accommodative. And it is quite clear to me that the Fed is going to pursue its aggressive stance and eventually become perhaps neutral, but not accommodative. And that's not what our prices are reflecting right now.
Meanwhile, J.P. Morgan Chase chief U.S. economist Michael Feroli says Fed officials are unlikely to raise rates by a supersized 100 basis points when they meet next week. San Francisco-based Twilio, a maker of customer service communication and marketing software, says it will cut about 11% of its jobs and restructure. Today, we're seeing Twilio shares surge by 10%. Recapping, stocks are trading mixed. S&P up 3 now, up 0.1%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much for that update. You are listening and watching Bloomberg Business Week. Carol Massar, Tim Stenovec. So among the things on our radar, it's also on investors' radar. It is among our most read on the Bloomberg today about the looming U.S. rail strike that threatens to push inflation even higher across the country. And Tim, this is coming, of course, after we saw this morning's PPI report where prices jumped more than expected last month.
Yeah, look, railroads account for a significant portion of goods that are transported within the U.S., more than a quarter of the goods transported here. So that would cause a real snarl, to say the least. Let's get into it with Katya Dmitrieva. She's U.S. economy reporter for Bloomberg News. She joins us this afternoon from in the field, just outside of Washington this afternoon. Katya, how are you?
I'm doing well. How are you?
Good. It's good to have you with us. Hey, before we get to what this strike is about, I want to dig into the economic implications of this, because it's something that you wrote about earlier today. Give us some numbers here. What would happen if rail workers went on strike?
Well, the stakes are definitely high. As you mentioned, just over a quarter of all goods are transported by rail in the U.S., and that includes everything from consumer goods to basic inputs that businesses use, really all businesses use.
Like oil?
So even like oil, like coal, like timber, lumber, I mean, you name it, and it's probably on one of these trains that could be, stopping as early as Friday if there isn't a deal reached. The estimates in terms of the economic impact, we got a Goldman Sachs note just recently, actually, a new note showing that it's $1.8 billion potentially at stake in 1 week for the Class 1 rails. That's just in the first week of if there's a stoppage alone. Broadly, we have an industry group saying that it's $2 billion of cost per day. And that's for the entire U.S. economy. And they factor in things like worker productivity and wages, all of the related organizations and companies that are involved, because if you can't get goods on a train, you're not going to need people to take them off the train, to get them onto trucks, to get them spent elsewhere. So the costs are really going to be adding up every hour of every day.
No pressure, President Biden and your team. Let's talk about that because U.S. Labor Secretary Marty Walsh has been holding conversations. You've been posted outside the U.S. Labor Department today. What do we know about those conversations?
That's right. Yeah, I'm here right now. The conversation started just after 9 a.m. this morning. So it's the two sides, the railway companies and the representatives and the unions, and then Marty Walsh and his team kind of acting as the broker middleman. And as you just said, I mean, the stakes are high and there's a lot of pressure to get a deal across. So what we know is that they've been talking nonstop since this morning. You know, at one point we were supposed to get some commentary from the secretary. We still expect that at some point today, but he hasn't been outside the building yet. And they actually kept negotiating all through lunch. So according to someone familiar, they just ordered lunch in and continued talks all throughout that. And you can tell from that kind of a pace of talks that this is pretty serious. We're getting down to the wire.
TikTok, though, when we look at the clock, Katya, under the Railway Labor Act, right, Congress can step in to either impose a resolution based on a presidential emergency board plan that was submitted in August or order the trains to operate as usual while the two sides continue to negotiate. So is that likely to happen even if they don't come to some agreement?
Yeah, that's right. That continues to be an option, right? So it's what they did in the 1990s to avert a rail strike back then, which would have been equally as catastrophic to the economy. And politically, that's still an option on the table. But as my political colleagues and White House colleagues have reported, it's not necessarily something that they want to do. The ideal situation here is that they come to an agreement, the two sides, and, you know, hopefully hammer something out. But as far as right now, as far as we know, you know, the likelihood of that happening right this minute is not high. I mean, we had another union, a smaller union involved, send out a press statement earlier today saying that they don't agree to the current deal and are kind of holding out and could strike later. So, yeah, a big goal.
Katya, how big is the delta between what the rail workers want and what the companies are willing to give in the last 30 seconds we have?
Oh, yeah. Well, there's a lot of 30 seconds. I mean, there's wages, there's the ongoing wages and benefits issues, but I think scheduling is the top thing. So you're hearing a lot from both sides with the companies saying, you know, we're giving a lot as we can on scheduling, and then you hear the unions and the workers saying, well, actually, we need more flexibility and we need more. We need you to give more, essentially, and that's really the main sticking point here, and probably exactly what they're discussing right now.
And we do want to mention we have a headline crossing. Amtrak is canceling all long-distance trains starting September 15th. So talk about some additional pressure, certainly on our individuals in the United States as well as our economy. Katya Dmitrieva, U.S. economy reporter at Bloomberg News outside the U.S. Labor Department in Washington, D.C.
Let's stay in Washington, D.C. and go over to Nancy Lyons, who's standing by in our 99.1 newsroom. Hey, Nance.
Thanks, Tim. President Biden is in Detroit for the auto show, and he's promising cleaner cars for the future.
The Great American Road Trip is going to be fully electrified. Whether you're driving coast to coast along I-10 or on I-75 here in Michigan, charging stations will be up and easy to find as gas stations are now.
Biden has announced approval of the first $900 million in infrastructure money to build EV chargers across 53,000 miles of the national highway system in 35 states. Sweeping sanctions against Russia have cost the country hundreds of billions of dollars. That's according to an internal finance ministry document, which found there have been significant hits to the stock market, bank capital, and foreign exchange reserves that were frozen by the restrictions. Russian President Vladimir Putin gave officials an upbeat outlook on Monday, saying the nation is, quote, heading for a growth trajectory. Well, the special counsel appointed by former President Donald Trump to look into the origins of the so-called Russia probe is apparently winding down, as we hear from Bloomberg's Nathan Hager.
The grand jury convened by former U.S. Attorney John Durham has expired, and sources tell the New York Times he has no plans to call another one and is working to finish his final report by the end of the year. Former President Donald Trump and his supporters had hoped the special counsel investigation would prove a deep state conspiracy to undermine his 2016 campaign. Durham has developed cases against two people accused of lying to the FBI, but has not brought any conspiracy indictments. In Washington, I'm Nathan Hager, Bloomberg Radio.
Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nance, thank you so much. Nancy Lyons in our Washington, D.C. newsroom and bureau. Carol Master, Tim Stenovic here live on Bloomberg Business Week in our Interactive Brokers studio. A couple of stories we want to mention, and this has to do with the relationship between Russia and China, which has definitely come to the forefront as a result of Russia's invasion of Ukraine.
Yeah, well, shortly before invading Ukraine back in February, Vladimir Putin and Xi Jinping declared a no-limits friendship. Yet, even as his forces suffer humiliating losses on the battlefield, Russia's president shouldn't expect much help at his first meeting with his Chinese counterpart since then.
Yeah, what's interesting today, President Xi and President Putin meeting face-to-face in Uzbekistan, their first sit-down since a Beijing meeting before the Winter Olympics that yielded a lengthy joint statement of more than 5,000 words. In it, they vowed to have, quote, no forbidden areas of cooperation in challenging the U.S.-led global order and pushing for a multipolar world.
But remember, back a few months ago to February, it appeared that China was caught off guard when Putin invaded Ukraine a few weeks after that meeting. Officials in Beijing initially struggled to both support Russia and avoid endorsing a clear violation of sovereignty, a pretext that could be used to justify foreign intervention in Taiwan, which China claims as its territory.
This is going to be one of the great geopolitical discussions, realities, I think, of our time. What is the relationship between China and Russia specifically? And remember, after that invasion, because of the meetings that had gone on between Russia and China, we were all curious, how much did President Xi know about the invasion ahead of time? And there was a lot of questions about that.
Hey, well, I want to get to another story that's among the most read, Carol. Putin's options narrowing after Ukraine delivers a battlefield route. If you've been following this over the last couple of days, you've been seeing that Ukraine has actually made some headway when it comes to the battlefield. Criticism of Russia of the sudden retreat in the northeast Kharkiv region over the last week has spread from nationalist bloggers to mainstream political figures. Its forces, though, Carol, still holding key positions in the Donbass region in Ukraine and putting up a fierce fight against its troops to the south.
It does make you wonder how much longer this goes on. I think we're all kind of shocked that it's gone on as long as it has, but how much of potentially some of the Russian retreat might cause to bring it to an end. I think at this point it's still a lot of questions. All right, more to come right here on Bloomberg Business Week on Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Do want to begin with a developing story amplifying on an earlier headline. Amtrak is going to be canceling all long-distance trains beginning tomorrow, quote, to avoid possible passenger disruptions while en route as that nation rail strike looms. Importantly, though, most travel within the Amtrak-owned Northeast Corridor, including Boston, New York, and Washington, as well as related branch lines to Albany, New York, Harrisburg, Pennsylvania, and Springfield, Massachusetts, would not be affected. U.S. equities, they're trading mixed. Yesterday, we had the Dow Jones Industrial Average plunging 1,276 points. Today, this afternoon, the losses continue, with the Dow down another 83 points, down by about 0.3%. S&P lower by 3, down 0.1%. NASDAQ up 26, holding on to gains, up now by 0.2%. The 10-year yield, 3.41%. The 2-year yield, 3.77%. Spot gold down 0.3%, $16.96 the ounce, while West Texas Intermediate crude is up 1.6%, $88.69 for a barrel of WTI. Key takeaway here, we've got stocks swinging between gains and losses a day after that hot inflation report sparked the biggest rout in more than 2 years. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. So this is one of those stories that we have come to love Business Week for. It's one that taps into some of the big themes of our time, but may not be on your radar, but should. And Tim, it's about a prime spot between Mexico's industrial capital and the U.S. border that's become a haven for Chinese manufacturers.
Yeah, it's in Monterrey, Mexico. It's if you look at a map, it's just south of the border with Texas. It's an area of the country that has really changed a lot in just a few years. Writing about it in Bloomberg Business Week magazine. This story is going to be featured in the upcoming issue of Business Week magazine. Read it now, though, on the Bloomberg and at Bloomberg.com/businessweek. The editor of this piece is Christina Lindblad. She's global economics editor. She's with us in the Bloomberg Interactive Brokers studio. Also here is Joel Weber, the editor of Bloomberg Business Week. You can follow him on Twitter at Joel Weber Show. So this area of Mexico, northern Mexico, just south of the border with Texas, what did it look like a few years ago, Joel?
Well, it was a little quieter than it is now with fewer factories. And lo and behold, China became very interested in sort of a side door to the U.S. there. And so we have seen an explosion of factories there. And it is effectively a workaround of Trump's tariff policy, which the Biden administration has basically kept in place. And so what's interesting about that is that, they basically have gamed the system. And so things going forward may not be manufactured in China as before. You find some cheap real estate in other countries. Mexico is not the only version of this, but certainly the closest to the U.S. So how's this working out as a little bit of arbitrage, Christina?
Well, that's the globalization is always arbitrage, right? So I think when we interviewed companies that are based in one particular industrial park that we focused on, most of the Chinese firms prefer to emphasize the proximity to the U.S. market and the savings on shipping. But when pressed, they admitted that, for example, one furniture maker was facing tariffs of 25% when they were shipping from China, and now qualify for duty-free shipments into the U.S.
What blew me away is how quickly they were able to do that, right? Like, I always feel like when we're talking to CEOs and like, well, the shift, if we have to shift our production elsewhere, it's going to take a long time. I mean, they move pretty quickly. And it reminds us that they are still the manufacturer to the world.
Yes, and I think some of these companies are they're not all big. I mean, one of the manufacturers is a really big manufacturer in China, but so they are nimble, and they, as a policy, China has been basically willing to shed kind of low margin manufacturing businesses as it focuses on high end stuff like new fuel vehicles and biotechnology and semiconductors. So I think the first wave went to places like Vietnam, but now you can see businesses are moving further away from those comfort kind of locales where they first landed. And yeah, I mean, I think what I thought was kind of funny was that do you remember when Trump tweeted basically ordering American companies home?
Yeah.
And I said, what came floating across like the Pacific were Chinese plants.
Didn't exactly work that way.
I don't know. It seems like there could be like a way for the U.S. to close this loophole. I mean, they know what these Chinese companies produce, and isn't there a way that they can say, okay, well, we know that it comes from a subsidiary of a Chinese company, and you're not sticking to the spirit of the rule. We're going to tack on that tariff.
Do they want to?
Oh, I don't know. I mean, that
too.
might cause issues with the USMCA, right? Like the successor to NAFTA. I mean, I think Mexico would have legitimate reason to say, what are you doing? You know, as long as they meet the content requirements, which they are, and to do that, I mean, we should be clear that this implies a certain amount of effort on the part of these Chinese companies because they're having to source products from Mexico, could be even North America. They can't just assemble everything from Chinese parts and ship it across.
Yeah, other thing to keep in mind here, you know, Belt and Road is a very top-down initiative in China. This is not that.
Yeah,
this is just
grassroots.
A grassroots effort by Chinese exporters to be like, how do we get around this?
It's kind of simple, but it makes so much sense.
Yeah. Right.
Also, I mean, we talked to some companies that off the record explicitly said part of the reason we're doing this isn't just cost savings, is that there's political risk, policy risk rather, in China. In recent years, we've seen like crackdowns in tech and other sectors, and so, you know.
So we talked about the Mexico side of this too. AMLO being obviously the president of Mexico has been, you know, very eager to try and get employment wherever there can be employment. How is this shaping out domestically for him?
Well, the interesting thing is at the federal level, Mexico has never really actively courted Chinese investment because they see Chinese exporters as rivals in third markets, right? So, but at the state level, states have. So Nuevo León, which is where, you know, this particular industrial park and a lot of these companies are setting up shop, has done, and they're building a special road, for example, from from the industrial park to the border. And so, yeah, but I think that some people have said that Mexico might have actually seen even a bigger windfall of this kind of investment if AMLO was being less nationalistic on topics like energy and, you know, and things like that. But
I mean, this is great for Mexico, right?
Yeah,
and
yeah.
The number that really jumped out at me here is nearshoring could boost Mexico's exports by $35 billion a year. A bit over 7%. I mean, that's
real.
That's
real.
Transformative, yeah. Also, I mean, while the Chinese investment, like the most recent figure is $500 million a year, is not huge. There are a couple of deals that could happen this year that would be transformative. That we're talking about billion-dollar factories. One of them is there an EV engine maker that's looking at 2 different sites in Mexico, and those kinds of investments pull supply chains, you know, around them, you know, so that kind of thing I think would take it to the next level.
Right, it's all the suppliers that play into
Yeah.
it. Hey, you guys point out in the story though, Chinese companies aren't the first to seek shelter from U.S. tariffs.
That's right.
Japan did it, back in the...
Yeah, similar playbook when Reagan started layering all these different restrictions on Japanese cars. And then when NAFTA took effect, they saw, well, this is a great export platform now.
But I think it's interesting, right, in terms of the globalization conversations that we're having about what's going on.
Yeah, I forgot about that. We haven't talked about that forever.
Well, I mean, the way I think about it is like
globalization. What?
Yeah, don't
Nearshoring, Joel.
Nearshoring. Yeah,
That's
there
what
we
we're
go.
Well,
calling it.
we didn't use the word friendshoring, which is what some people.
Friendshoring?
Yes, that's when you go to friendly countries, like, you know.
Oh, I haven't heard that.
Are we friendshoring right
We can
now?
have a special edition on, you know, Wonk Talk.
Stay tuned. To come. All right, we got to go, guys. Jill Weber, editor of Bloomberg Business Week, here in our Interactive Broker studio, along with Christina Lindblad. She's Global Economics Editor. This story, it is a Bloomberg Big Take, and it is in the upcoming new issue of Bloomberg Business Week magazine. It's on newsstands tomorrow.
Countdown to the Close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is Countdown to the Close. Just 60 minutes left in your trading session. Caroline Hyde, Romain Bostic, Taylor Riggs, joined now by our colleagues Carol Massa, Tim Stenovic. The gang is back together. We are going across TV, radio, YouTube too. Well, I have to say, a bit of a lackluster day in terms of actual benchmark moves, but volume is surging on the S&P once again, Carol.
Yeah, but bouncing around a lot, but I agree with you. Very little change. I was looking for some outperformance in the market today, and I saw that in the semiconductor names. They were up as much as 1.8% at their highs today, still holding on to about a 0.5% gain, but, you know, they're still down more than 30% so far this year, Tim, and that is worse than the S&P 500 and the NASDAQ 100.
All right, you found some outperformance. I found some underperformance. Let's talk rail stocks. CSX, Norfolk Southern, Union Pacific are all lower today. We got the news just in the last hour that starting tomorrow, Amtrak is going to cancel all long-distance trains to avoid possible passenger disruptions well en route as a national rail strike looms. Goldman now out with a note saying that a rail strike could cost operators $1.8 billion in revenue.
It'll be harder for Goldman to get its bankers back in the doors as well with commuting issues. Let's have a look at the majors, because amid these supply chain snarls that once again we confront and the inflationary pressures we continue to digest, we're on the lower side, only by 3 points on the S&P. Yes, PPI came in softer, so that gave us some relief after yesterday's monumental sell-off. The Dow off by 0.25%. The NASDAQ is the only one in the green, up about 0.2% after yesterday's almighty sell-off. And the Russell 2000 basically flat, 1 point lower, Taylor.
You're really seeing that push-pull narrative on an individual sector level. Take a look at this. Only 3 sectors in the green. Energy, utilities as well. Sort of those classic safe havens when it comes to utilities, a little bit higher. All the way down at the bottom, Romain, this is where things are getting interesting. So you're having most of those sectors in the red. Real estate, materials, financials, industrial. So some of those sort of classic risk-on sectors also really here to the downside.
And still a lot of caution out there, at least with regards to some of the commentary that we're getting out of CEOs. Nucor actually pre-announced, and the guidance was well below what the street was looking for here. They really talked about the idea of demand, and we were really talking about metals demand here, and steel in particular, and how that demand is now starting to wane. They're seeing actually a significant pullback in construction activity, at least the construction activity that would rely on the type of steel that they provide. Nucor shares down 11% here on the day. We also heard from the CEO of Verizon also talking about a potential slowdown in its business. It did actually say that some of that was due to its hiking prices last quarter. It did say that that was the right decision to do, though it did cost it some customers. It thinks that that could be a short-term blip. Those shares down 1%. To the upside, though, you're seeing some pretty decent moves in Moderna, up by about 5% on speculation that it could supply a COVID vaccine to China. And Starbucks shares up 5%. They had that investor day laying out a 3-year plan that most investors seem to think can be achieved, a 3-year plan that
Can you believe that they
CEO,
can see 3 years ahead?
well, especially considering that the new CEO hasn't even started. Has someone asked him about this 3-year plan?
Yeah, exactly.
I mean, I think he officially starts at the end of this month or the start of next month, but he doesn't officially become CEO until April, and they're laying out 3-year plans here. So it'll be interesting to see how that sort of sorts itself out.
Yes, Schultz is on board until at least April, I think, just hand-holding a little bit of the transition. Let's look, though. Romain, you brought this up yesterday, again, the valuation question, and the fact that we had the significant sell-off yesterday. Valuation still relatively elevated. We thank Peter Terrace for this sort of a chart, just showing that we're basically at the 10-year average right now, dipping slightly below it, but if you're looking at forward-looking PE ratios over here, we are seeing, in general, 17.1. The 10-year average is 17.2.
Look at this chart in its entirety for our TV audience, because not only is it back down, but think about what economic conditions were in those previous years compared to where we are today. I think there's an argument to be made that that blue line should be a little bit lower than where it is right now.
Yeah, right. It all depends on what the outlook is, right? And if these recession fears come to fruition, I do wonder about if valuations have to come down even further. Well, here's something that maybe investors might get freaked out about. Legendary investor Mark Mobius catching up with our overseas team a little bit earlier on Bloomberg Television. He talked about how high he thinks the Fed may go when it comes to rates, and a little bit of warning, this may catch your breath a little bit. Here's what he had to say.
The Fed has a game plan. Their game plan is to make sure that the interest rate is higher than inflation. That's the way they believe the way to kill inflation. So you have 8% CPI, that means you have to have 9% interest rates. So we're going to see higher and higher rates if these CPI numbers keep on coming this way.
And of course, that is Mark Mobius, running his own firm, running his own money, and of course, someone who's seen a lot of market cycles. But guys, I do wonder, like, if something like that came to fruition, I think about, Caroline, that chart you just put up in terms of valuations. If that comes to truth, you know, how much valuations would have to come down?
Yeah, but you know, we got a long way to go to get to 9% if that actually happens. I mean, you have JP Morgan coming out and saying today, don't worry about a 100 basis point move at next week's Fed meeting. You know, Murrow was talking about it yesterday. Yeah. It's going to be 75. Yeah. But you know,
let's be clear here. I mean, with the 9%, I mean, I understand the point that he's trying to make. It's extreme, but it's also the idea that at some point, in theory, this is all going to meet in the middle, right? The idea that as rates continue to go up and inflation comes down, hopefully. But that's what history says. History says that we don't need to go to 9%.
All I will say is if you take a look at sort of the panic that we had yesterday, try to understand where we are with valuations, the future panic may be on the horizon. The maybe consolation of this is you didn't see mass hysteria within the credit markets. You didn't see mass spread widening, mass CDX spread upticks here. So maybe some of that consolation. What's that word?
Consolidation?
Consolation. There you go. Yeah. Consolation.
Make happy?
Is that you
what did you do? What did you do with the
She's so mad.
What did you do with the thesaurus that I gave you for Christmas? Are you not using it?
There we go. I need to open
This
up
job is hard sometimes, right? Like,
but we're thinking live on the
Well, as we're struggling for words, I mean, I think the volatility, though, you're right. We didn't see a breakout in terms of credit spreads. And also the VIX, the fear gauges, they didn't blow out much either. This is really just a sort of blink. And actually, I think Cameron Christ had a great piece. The idea that actually, if you'd just been off for a week, like someone in this particular team, you come back and you'd be like, so what if you looked at the levels of where we are today?
This is why I put down my phone. I don't look at the markets, and I'm like, okay, wait, we had a rally. Oh, wait, we had a sell-off. We're back where we were. I mean, this is what everybody talked about, I feel like, months ago, that this is the kind of market we're going to have, and it certainly is playing out.
Well, Sam Stovall, right? We played his clip earlier that, you know, obviously not about the bounce today, but about what happens by the end of the year, that we could actually see some gains by the end of the year. We'll have to wait.
All right, we're going to have to wait for some more conversation from the five of us. We'll be back, though, in just about, less than an hour's time. We're going to count you down to the close.
Good math.
I've been away from a
We do math, we do English, we do talking.
It gets hard when you come back. All right, Beyond the Bell, we're going to count you down to the close on this Wednesday, 4 p.m. Wall Street time.
This is Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, Carol Masser, Tim Stenovic. It's so true when you walk away for a little bit, and it's just amazing, like the stuff that goes on. I did do like kind of spot checks because I am curious about big stories. And
so were you? But you weren't reading your email, right? Okay, that's good. You shouldn't when you're on vacation.
It's a little rough when you come back, though. You're like, oh my God, how many? 1,000 emails? You know, I think what we're going to see, though, in terms of the trade, I think it would be safe to say that it'll start to calm down a little bit because we're going to wait for what the Fed has to say next week and what we get in terms of maybe clarity about what's still to come, how aggressive they continue to be. And I agree, Mark Mobius, he has seen a lot of cycles. It's a pretty big number, but who would have thought some of the inflation numbers? I certainly didn't think the prints would get as hot as they did. And it's persistent, it's staying, it's sticky.
Yeah, that's the concern, right? It's that it's not actually coming down as quickly as it went up. And even if we talk about the idea of peaking, right, and coming down, decelerating,
correct,
it doesn't mean that we're getting down to that Fed funds, that Fed target, of 2%.
Right, and how long will it take to come down? Will it kind of come down for a little bit, plateau again, come down? And I think geopolitical plays into it. Look at what we're seeing about, what's going on, chronically over in Europe in terms of their concerns.
Yeah.
Energy, food, you name it.
Exactly, so the macroeconomic stuff there, and then here, the rail strike, I keep going back to that.
It's another thing. And we talk about then climate change. You layer that on top of things, whether it's extreme drought, extreme rains, that plays into food production, which plays into food costs. I mean, it kind of, just as we think we have turned a corner, something happens. And we, get little comments from CEOs, whether it's McDonald's CEO talking about 2023 and some concerns about that. I mean, this is where that CEO commentary continues to be really important.
Plays into the Business Roundtable data that we got earlier, that CEO confidence is at a two-year low.
I wasn't picking up my phone. What was it, 2-year low?
Yeah.
Yeah.
We got it today, Carol.
Yeah, okay. I'm sorry.
I'll send it
I was reading in a lot this morning, trying to play catch up. All right, you are listening to Bloomberg Business Week. Carol Masser along with Tim Stenovic. Off to D.C. we go. World and National News with Nancy Lyons. Hey, Nance.
Thanks, Carol. The world is within reach of beating the COVID-19 pandemic. That's according to the head of the World Health Organization. Director General Tedros Ghebreyesus is sounding upbeat, but is still urging countries to keep working to control the virus. Fewer deaths were linked to COVID around the world last week than at any time since March of 2020. Well, new poll numbers show that most Americans are ready to move on from COVID-19, even when they understand the risks. We get details from Bloomberg's Amy Morris.
The poll shows most Americans have returned as much as they can to life before COVID, even after a spike in COVID cases this past summer. The Axios Ipsos poll finds that while most Americans believe there's still a chance they could catch COVID, their perceived risk of contracting the virus continues to decline. More Americans now believe that out-of-home behaviors like attending in-person gatherings, going on vacation, or going to a sporting event pose no more risk to their health now than it did in mid-August. In Washington, I'm Amy Morris, Bloomberg Radio.
Businesses and commuters are waiting to see if a freight rail workers' strike happens on Friday. It will have a ripple effect on passenger service, and Dean of Cornell's Industrial and Labor Relations School, Alexander Colvin, tells Bloomberg it will also affect the overall economy.
We're seeing estimates of $2 billion a day impact on the U.S. economy. Railroads are really critical, moving large amounts of freight. And so a railroad strike of this nature, a national strike like this, would have an enormous impact.
Colvin says workers are not only seeking raises, but better work conditions. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nance, thank you so much. Carol Master, Tim Stanovic, live in our Bloomberg Interactive Brokers studio on this Wednesday. We wanted to bring to your attention a story that we saw in the Wall Street Journal Dow Jones, and this has to do with regulators and their communications and dealings with Citigroup, because regulators, and I'm reading from this Dow Jones story, frustrated with the progress Citigroup has made in the 2 years since they reprimanded the bank for problems with the systems it has in place to prevent costly mistakes. This is according to people familiar with the matter.
Again, reading from the Wall Street Journal, which is available on the Bloomberg terminal, Fed Reserve officials have repeatedly grilled CEO Jane Fraser about the bank's plans to fix its risk management system. They've demanded to see more progress, this according to the People. And Dave Benoit writes that in a meeting this summer, officials from the Office of Comptroller of the Currency warned the bank's board that there could be consequences for not getting a handle on the situation.
Now, remember what happened. The Fed and the OCC fining the bank $400 million. That was back in October of 2020, citing, quote, significant ongoing deficiencies in its risk management systems. In a series of consent orders, they demanded Citi to make a lengthy list of improvements to its web of technology and procedures designed to detect problematic transactions, risky trades, and anything else that could harm the bank. Remember, that reprimand hastened the departure of Citi's former CEO, Michael Corbat, and really brought Jane Fraser into the top job at the nation's third largest bank. So a big upheaval at the bank.
Yeah, she's been trying to fix the problems. Listen to what the bank has done when it comes to employees. So it's got 230,000 employees worldwide, more than that. The bank added 30,000 employees to teams involved in fixing the problems over the past 2 years. That's according to a recent memo from CEO Jane Fraser. Again, reading this story from the Wall Street Journal, David Benoit writing that regulators want Citigroup to move faster to fix problems with risk systems.
And some of it goes to the heart of what Citi was. Remember, it was just a ton of different companies and
You're talking pre-financial
facilities.
Crisis?
Yeah. I mean, they had a bunch of deals in the 1990s. It made the bank into what, remember, we used to call a financial supermarket, and they never integrated many of the operations, according to, again, the reporting that's being done by Dow Jones, and so that led to some of the problems. All right, read more on the Bloomberg terminal.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. The selling now intensifying. The Dow, the S&P, and now NASDAQ all in the red. We are at the worst level of the session with 43 minutes to go ahead of the closing bell. Let's head right over to the first word breaking news desk for today's afternoon call. Here he is, Bailey Lipschultz.
Good afternoon, Charlie. As you said, stocks had swung between gains and losses, but are now trading at session lows. The Dow is down 210 points, S&P lower by 15, with the NASDAQ falling 20 points. The U.S. 10-year yield is unchanged at 3.41%, and small caps are down 5. 7 of the 11 main S&P sectors are trading lower, with real estate and materials providing the biggest drag, while energy and consumer discretionary are leading to the upside. NASDAQ biotechs rise 20 points, transports fall 95, semis are higher by 10, while the VIX is down 2%. Leaders in the Dow, Chevron, J&J, and Merck, while Honeywell, 3M, and Dow Inc. are the worst performers. After earnings, Nucor fell the most since December after a disappointing forecast, and J&J gained after announcing a $5 billion share buyback. Twilio rallied after saying it will cut nearly 11% of its workforce, and Citigroup dipped after a report regulators want the bank to move faster on problems for its risk systems. Wrapping things up, Moderna rose on a report it's held talks about supplying China with its COVID vaccines. Live from the First Word Breaking News Desk, I'm Bailey Lipschultz. Charlie?
Okay, we thank you very much, Bailey. And to hear live breaking news over your Bloomberg, type squawk, SQUAWK on your terminal. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, shares of Walmart, I think little changed on the day, at least when I checked it last. This is the world's largest retailer, gets ready to offer up checking accounts.
Yeah, this is a really interesting story. Jenny Serrain is with us. She's finance reporter for Bloomberg News. She's with us in the Bloomberg Interactive Brokers. I mean, it kind of makes sense when, you know, a company like Walmart wants to continue to grow. It has to get into other parts of business. The question that I have is, who are these checking accounts meant for, these bank accounts meant for? Walmart has more than 1 million employees. Have they been kind of like trialing this with the employees? What's going on here?
Yeah, so that's what we're actually expecting to see in the coming weeks. So Walmart last year actually set up this outside fintech startup, and they've been super secretive up till now, and we're basically expecting them to roll out these new bank accounts in the coming weeks to, for now, a small set of Walmart's employees here in the U.S. and even a small percentage of their online shoppers. So it's kind of in test and learn mode right now, but pretty soon they are expecting to roll this out to 1.6 million Walmart U.S. employees and all Walmart shoppers as well.
First of all, kudos to you. It's an exclusive. It's among the most read on the Bloomberg, so really, really well done. What's interesting to me, and it also speaks to me that they're going after what many would say are an underserved part of our population when it comes to the financial infrastructure here. It's kind of super smart.
Yeah, I think that's exactly right. Walmart is very keenly aware of what all of its customers really need and kind of the gaps that can be filled. And so they've talked a lot about how they want this to be something that's affordable. So you can, imagine that there probably won't be lots of fees attached to this new account. So yeah, I think it's a very interesting move for them. I will say they've tried this in the past. So this is not Walmart's first foray into finance. And they haven't always been successful. So I think they're taking another whack at it. They're trying to go a little bit more digital, a little bit more flashy. So we'll see if this time makes a difference.
How long ago was their last attempt, do you know?
It's been a while. So they currently have a bevy of financial services products. So you can get a reloadable debit card. You can change money.
The reason I ask is because we're in a mobile-first world right now. Yeah. And that's a big part of the, quote-unquote disruptors who are coming into fintech. And Jenny, you've written a lot about these companies like, companies like Dave and Chime and other one-word, so-called neobanks, right? So even though, it could be a smart move from Walmart, this is a really crowded field already because a lot of companies are going after that underbanked consumer.
Yeah, no, that's exactly right. I do think the fact that so one of the big problems facing those other companies right now is they have to spend so much money acquiring customers. And these guys have kind of the built-in advantage. You know, they've got the world's largest retailer with 5,000 plus stores ready to advertise this, put this in front of their shoppers, put this in front of their employees. So that helps a lot. It means their expenses will be a lot lower, and maybe they can spend that money on something else.
All right, can I just share with the audience that before we got going, you and I were talking about Shark Tank, that while I was home, I kind of did a little bit of a deep dive and did a little bit of binge watching. I like Shark Tank, but I feel like
Carol's vacation, binge watching Shark Tank for the last 2 weeks.
I find it fascinating because this is so much the backbone of our country and our economy, all these small companies, but so much they talk about customer acquisition. And I think if I am an individual and I shop at Walmart, I know the brand, it's a company that's been around for a long time, and I would be, first of all, comfortable with it. And then I think about for Walmart, right, they're right there. It's not going to cost them a lot to get to these additional customers for financial services.
Yeah, no, that's exactly right. I mean, I think one of the most interesting stats was Walmart has more locations than all 4 of the major biggest banks in the country.
Who've been closing them.
Exactly. So, you know, if you're really thinking about a subset of customers who, while mobile first, do like that kind of in-store experience, this kind of checks all the boxes for them.
Okay, so I don't know.
You're just dumbfounded that I did a deep dive on Shark Tank.
Yeah, I don't know.
Hey, Jenny and I are bonding on this. Anyway, go ahead.
Jenny likes Shark Tank too.
I know, it's fascinating.
Yeah,
I'm a fan.
Everyone likes Shark Tank. So what does this end up looking like for Walmart's bottom line here? Because this is something that investors certainly want to know about. And in the past, large companies getting into financial services didn't always end well. I'm talking about, GE.
Yeah, no, that's actually a great point. I think the way they structured this is super interesting. So they set up this outside fintech. It's completely independent, but they are the majority shareholder, and they're also, a lot of their executives are on the board of this outside fintech. So they have a vested interest, but it is a separate effort. So I think we'll see. I can't imagine that right now the financials are what's most compelling. I think it's the idea that when you're a consumer, you can go to Walmart now and basically get anything, not just your groceries or your gas, but also your bank account. So
your
I think
tires
for now,
on the car.
It's the Amazon model, right? You've already got how many users embedded in your system. What else can I offer them?
I actually think of it more of the Alibaba model, because those guys really started out in retail and then slowly branched their way into every other thing. And so you're starting to see those models kind of make their way here to the U.S.
But it makes so much sense, right? You've already got this install base, and how do you monetize it even further? As we said, it's an exclusive. Thanks to our Jenny Serrain, finance reporter at Bloomberg News. It is among our most read on the Bloomberg. So if you want to read it in its entirety, be sure to check it out. And check out Jenny also on Twitter. She's at Jenny Serrain.
All right, let's do another check of the markets because we are, little more than a half hour away from the market
You're asking
close
me
this
time.
afternoon.
I don't even know what day it is.
We're still down close to 0.3% on the S&P 500. The Dow down close to 0.5 percentage point. The NASDAQ hanging on to a little bit of green, Carol, up close to, we're pretty much flat right now, but it's green. 0.3%.
Just off our lows of the session, so a lot of pressure. All right, you are listening to Bloomberg Business Week, watching us on YouTube. Carol Massar, Tim Stanovec. This is Bloomberg Radio.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
All right, you are listening and watching Bloomberg Business Week on this Wednesday. Coming up, we've got another one of our most read stories on the Bloomberg terminal.
Annie Masa's in here to talk about a quant shop with ties to FTX powering Bankman-Fried. We're talking about SBF, Sam Bankman-Fried, his crypto empire. We're going to get to that in just a minute. First up, though, Charlie Pell, less than a half hour to go.
Indeed, and familiar theme in the final 30 minutes of trading here. Tim, we have got the Dow, the S&P, NASDAQ, all in the red right now, giving up earlier gains. The Dow right to the numbers, down 208. That is a drop now of 0.7%. Got to keep in mind that yesterday we had the Dow plunging 3.94%, down more than 1,200 points. S&P right now is down 0.5%, lower by 19 points. NASDAQ down 18, a drop there of 0.2%. A couple of minutes ago, we did have NASDAQ pushing higher. The 10-year, 3.41%. The inverted 2-year, 3.79%. Spot gold down 0.5%, 16.94 the ounce. West Texas Intermediate crude now rallying by 1%, 88.16 for a barrel of WTI. Stocks swinging between gains and losses a day after that hot inflation report sparked the biggest rout in more than 2 years. The looming rail strike is threatening to push inflation even higher across the country after prices jumped more than expected last month. What about the potential economic impact? Julia Coronado is president and founder of Macro Policy Perspectives, and she was interviewed today on Balance of Power.
It certainly is a risk that it's yet another friction in the supply chain. But again, that comes at a time when consumer demand is cooling for goods. So how that plays out in the realm of retail inflation is hard to say. But it does, it's just another indication of the disruption and disequilibrium that we continue to be navigating.
And today we see railroad stocks moving lower. We've got Union Pacific down 4.3%, CSX lower by 1.7%, Norfolk Southern down now by 2.6%. Amtrak, meanwhile, has canceled all of its long-distance trains as those White House-led talks continue. Amtrak, though, runs on its own lines in the Northeast Corridor. That means that Amtrak trains between Washington, New York, and Boston will not be part of Amtrak's planned shutdown. Recapping, stocks lower on track for a lower close. S&P down 17, a drop right now of 0.4%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, another one of our most read stories on the Bloomberg today. It's about what's been a little-known quant shop with its ties to a crypto trading powerhouse. As a result, it turns out it's actually becoming a lot more influential.
Yeah, we're talking about something called Alameda Research. As Annie Masa writes this today, I should say, it sounds more like a Silicon Valley robotics lab than a crypto trading powerhouse.
There's a lot to unpack here.
Yeah, there is, and it's all tied to a really important person when it comes to crypto. We're talking about SBF, Sam Bankman-Fried. Annie, good to have you with us. Annie Masa is joining us. She's investing reporter for Bloomberg News. Annie, what is Alameda Research?
So Alameda was co-founded by Sam Bankman-Fried, SBF, as you said, and it's a crypto trading shop. But a lot of people know SBF, at least recently, outside of crypto circles, from obviously FTX, which is a very visible exchange for crypto. And, you can find sports stadiums that have FTX's name all over it. Alameda is a little bit different. It's lesser known, but a huge driver of SBF's crypto fortune.
So talk to us about the relationship between these two, because I don't think everyone knew, right, this relationship.
Absolutely.
And it sounds like they didn't want everyone to know about this relationship, perhaps.
The DNA of proprietary trading firms, independent trading firms on Wall Street, can be very secretive. And as it turns out, the DNA of Alameda is also kind of that secretive trading firm DNA. So you have executives there that have come from places like Jane Street and Susquehanna, which are really powerhouses in trading, but also not as visible as like the New York Stock Exchange or, Goldman Sachs or something. They fly under the radar. So Alameda came first. It came before FTX. And after SBF left his job at Jane Street, he created Alameda out in California and he got his start with kind of arbitrage opportunities in crypto that way.
Okay, so Sam Bankman-Fried has been sort of this knight in shining armor when it comes to rescuing crypto firms that have gone under of late, coming in at kind of the last minute and in some cases buying them for essentially pennies on the dollar, or getting the option to buy them. How does Alameda work with that?
That's right. So Alameda, we kind of cite some of this data in this story. There have been different investments that SBF has made by himself. There have been FTX venture investments, and then also Alameda. So Alameda has its own venture arm. And one of the things that's kind of compelling about the relationships is, now Alameda is based down in the Bahamas, where FTX is also based. There's a lot of social and connections among those firms, and until recently, the venture arms had ties as well. So it's a very interconnected kind of relationship, and it's one that's come to light, as you mentioned, in this period where SBF has really come to the forefront of the crypto winter.
And the concerns about, I feel like, oh my God, my brain's hurting. Because as I said, there's a lot to unpack.
You need like a whiteboard.
Which works really well on radio, works well on YouTube. But the concerns are preferential treatment, correct? And as you write in your story, nothing has happened as of yet, but there are the worries.
That's right. So stepping back, something that we looked at in the story is, situations where exchanges have close relationships and ties to market makers or trading shops. These have happened and still happen in equities, for example. But the concern that even regulators have showed in those situations is that the market maker that's affiliated with the exchange gets some kind of preferential treatment, which could, in theory, come out worse for the customer. Now, that's kind of the open question, right? And like we say in this story, that's not like necessarily an accusation that's being leveled at Alameda, but the regulation in crypto is much more nascent than it is in equities. So you don't have crypto exchanges that are registered with the SEC yet. So the SEC doesn't have oversight of, those stakeholders' financials and direct involvement that way yet.
Just 20 seconds. What about contagion risks with all these companies kind of tied together?
That's a great question. Yeah, it's something that we'll have to monitor, and as we find out more about the relationships and kind of watch the relationships among all these firms, it's something to keep in mind.
Got a word for you, transparency. Right? I mean, this is what we're trying to find out more.
That's what the blockchain does, Carol. It's all on the blockchain.
Oh, so we're all okay?
Yeah,
Everything's
we're all
done?
okay.
All right,
Yeah.
done. Lots more to come, and I'm sure Annie will be on it. Annie Massa, she's investing reporter at Bloomberg News here in our Interactive Broker studio. And check out more on Twitter and also on the Bloomberg.
Let's get a world and national news update. For that, we go to Washington, D.C. and Nancy Lyons. Hey, Nance.
Thanks, Tim. The White House is working to negotiate a deal between freight rail companies and their unions before a shutdown Friday. Bloomberg economy reporter Katya Dmitrieva says freight trains carry over a quarter of all U.S. goods, so a stoppage would have a severe economic impact.
We got a Goldman Sachs note just recently, actually, a new note showing that it's $1.8 billion potentially at stake in 1 week for the Class 1 rails. That's just in the first week of if there's a stoppage alone. Broadly, we have an industry group saying that it's $2 billion of cost per day.
Bloomberg economy reporter Katya Dmitrieva. Amtrak has already announced it's canceled all long-distance trains starting tomorrow. Well, it was cars, not trains, that brought President Biden to Detroit today. He promoted the conversion to electric vehicles while at the Detroit Auto Show.
The president said 35 states have applied for federal money to build electric car charging stations, eventually 500,000 of them.
Thanks to American ingenuity, American engineers, American auto workers. Today, if you want an electric vehicle with a long range, you can buy one made in America. If you want one that charges quickly, buy American. You want one that's fast the quarter mile by American.
The president said the Great American Road Trip is being electrified as the nation responds to climate change. In Washington, Irv Chapman, Bloomberg Radio.
People are streaming past the coffin of Queen Elizabeth II, which will lie in state for 4 days. At the Houses of Parliament, her funeral is set for Monday. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nance, thank you so much. Nancy Lyons out there in D.C. So this is our second most read story on the Bloomberg in the past 8 hours. Has to do with what Cathie Wood has been up to, especially when we saw the selling in yesterday's trade.
This story written by Katie Greifeld. The tech sell-off, or I think everything sell-off, excuse me.
It's pretty broad-based, right?
It was absolutely broad-based. It was brutal. It was in the aftermath of August's hotter-than-expected inflation print. It looked like an opportunity, at least for Cathie Wood's ARK Investment Management. She bought 27 stocks across 8 ETFs on Tuesday, according to data compiled by Bloomberg. Here are the largest buys, okay? Roku, it's already the third biggest holding in the firm's $8 billion ARK Innovation ETF. Wow, using the opportunity to get more shares of Roku.
Yeah, I mean, this is something she has done before. And, you know, she has often doubled down, right, when we've seen a stock trading off and then getting rid of some of the winners. And that's exactly what she did yesterday. Roku is nearly 71% lower this year, so she doubled down and buying big on that one. Butterfly Network and Zoom Video Communications, Tuesday's second and third largest buys by Cathie. They have dropped about 14% and 58% in 2022, respectively. Purchases were paired with the sale of roughly 1.5 million shares of Signify Health, which has seen its stock price soar about 160% since mid-June amid a bidding war for the company. So doubling down on those losers that she was already interested in and selling off some of the winners.
Yeah, I mean, it makes sense. And look, you know, you've spoken to Cathie Wood for years, Carol. I think she talks about you being among the first people who've interviewed her before she had, before she was the Cathie Wood of today. And one thing that you always remind us of is her 5-year time horizon. And like 2020 year was an incredible year for her. 2021, not so much. And 2022, not so much also. But she's making long-term bets.
One of the things I would say that has been very consistent to her, and I really credit to our producer, Paul Brennan, who, brought her to our attention as well. But that when she has a theory, she, for the most part, sticks to it and does think longer term about some of the disruption going on in our world. All right, more to come right here on Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg's World Headquarters, I'm Charlie Pellet. Choppy and sloppy as we head into the close here with the S&P down a point right now. Little changed, has been swinging between gains and losses. We have got the Dow Industrials solidly in the red, down 78 points, down 0.3%. That, of course, in addition to yesterday's plunge in the Dow when it fell by 3.9%. But NASDAQ holding on to a 33-point gain right now. We've got the NASDAQ Composite Index up by about 0.3%. The two-year yield, 3.79%. The 10-year yield, 3.41%. Spot gold lower by 0.4%, back below $1,700 the ounce at $16.95. Bitcoin moving lower by 1.6%, 19,916 on Bitcoin, while West Texas Intermediate crude is up 1.4%, 88.52 for a barrel of WTI. Bottom line here, stocks slipping in late trading a day after hot inflation sparked the biggest rout in more than 2 years. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. It's 3:48 on Wall Street.
The following is an editorial from Bloomberg Opinion.
This editorial was written by the Bloomberg Editorial Board. Russian President Vladimir Putin told a gathering last week that his country had not lost anything and will not lose anything in the Ukraine war. He may be less certain of victory today. An offensive by Ukraine's armed forces has made spectacular progress, reversing gains that took Russia months to achieve. Whatever happens next, there's no question that the charge has been a major strategic and operational defeat for the Kremlin. Allied nations must help Ukraine make the most of it by accelerating weapons deliveries and holding the line on trade and sanctions. Of course, Putin isn't defeated yet, but however the conflict unfolds from here, all wars end at the negotiating table. The West should ensure that Ukraine is in a strong position when it gets there. This editorial was written by the Bloomberg Editorial Board. For more Bloomberg Opinion, please go to Bloomberg.com/opinion or OPIN Go on the Bloomberg Terminal.
This has been Bloomberg Opinion.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, just got about 10 minutes left in today's trading session. Yep, choppy and sloppy is how Charlie Pellet called today's trade, and it's really accurate. We're bouncing off our lows, but well off our highs. Call it little change, Tim, overall for today's equity trade.
Eager to hear what Megan Horniman has to say, Chief Investment Officer at Verdance Capital Advisors. Megan this afternoon joins us on the phone from Hunt Valley, Maryland. All right, Megan, you've had 24 hours to breathe after yesterday's rout. Certainly a different story in today's equity markets. How are you looking at this? How are you looking at today's trade?
Well, I think today you're going to see, and even up to the Fed meeting, you're going to see a lot of this choppiness. It's just going to be an ugly market over the next week. The market's just waiting for that Fed report. And then even between now and then, we have quite a bit of economic data to digest. So I think you're just going to see a very sideways, choppy market until we get a little bit more clarity on exactly what the Fed's going to do.
Hey, Megan, what do you make of, we were talking earlier with some of our TV colleagues about the significance of, we had quite a rout yesterday, very impressive. The S&P basically giving back all of the gains it had made in the previous 4 sessions. But we didn't see a huge surge in the VIX, right? The fear gauge, which some meant to mean that maybe the sell-off was a recalibration of those expectations rather than panic selling. How do you see it? The VIX, again, down almost 0.75 point today.
Yeah, I think you're exactly right. The fact of the matter is that the market continues to be in this whipsaw mode where, something like that CPI report comes out and then they readjust the expectations for the Federal Reserve. The risk I see right now is, yes, that the VIX still hasn't really spiked up. You need to see that VIX much higher to say that we've really reached that full capitulation mode. But
so
also,
40, we need to hit 40 or what?
I think you need to hit 40 consistently and stay above that. I mean, we haven't been hit 40 since the pandemic, and we've seen quite a bit of daily moves and daily volatility, but we haven't really seen it translate into that VIX. That's what we want to see to say, hey, we might be getting in this capitulation phase.
Carol, were you the one who said a few weeks ago that with all the economic data we get and then the Fed, it's like we're jumping from stone to stone in the pond?
Yeah, it's like a little kid, skipping stones across a block.
That's what it feels like here, because it's like,
and
and I hear it time and time again, Megan, it's like, okay, we just wait for the next data point and then we're going to get some clarity. We wait to hear from the Fed and then we're going to get some clarity. But it seems like every time we get to one of these other stones, as Carol's sort of metaphor points out, we're still waiting to jump to that next stone. I mean, when are we going to start to see like a good understanding of what's coming in the U.S. economy?
Well, I think we have to get a little realistic, and there's certain areas of the market that I don't think are realistic right now. For example, earnings haven't been translated. The weakness we've seen in the economic environment, as well as what we expect over the next year, isn't really fully reflected in the earnings expectations for this year and next year. And then when you look at the Fed funds futures market, they're looking for Fed rate cuts as early as the first half of next year. The Fed flat out said they're not going to do that. They said they're going to keep hiking and then they're going to stay there. So I don't understand it. It really doesn't make a lot of sense to me on how the fixed income market can be translating this into Fed cuts as soon as early next year. As long as that continues, that there's not realistic expectations in fixed income or earnings, you're going to see this whipsawing along with economic data and Fed rhetoric.
Yeah, and speaking of going from the point to point, stone to stone, I think about going from earnings to earnings, and I am curious again, when we get to the next earnings round, Megan, what CEOs and their teams have to say about the outlook and what it means for a reset in terms of earnings growth, revenue growth, margins, what kind of pressures we continue to see, and whether or not that leads to valuation resets.
Mm-hmm. And I think we've got to look at what they're doing for the future. So I think you want to hear not just about what interest rates mean, but are they going to slow down hiring? Are they cutting jobs? Yeah. We're starting to see that now already, especially from some of these mortgage-related jobs.
Your Twilio, you're already, I feel like every day we have a company that comes out and says, and maybe some of them are very company-specific stories, but nonetheless, we talk about it with a lot of the big tech names, right? Mm-hmm. Feels like we went through a period, Tim, where it was every big tech name talking about slowing hiring.
Right, and maybe we'll see this reflected in tomorrow's, weekly jobless claims.
Yeah.
But, Megan, we're still not seeing the weakness anecdotally that we're hearing from these companies reflected in the monthly jobs reports.
Right. And again, I think that's going to take time because we still are dealing with a pretty tight labor market. I mean, you have almost 2 jobs out there still for every one person unemployed. So there still is a very job plentiful environment. I don't think you're going to see that really translate into those jobs numbers. And we hope it don't. We don't. That's why some people are still holding on to the soft landing environment over the next year, because we do have such a good labor market.
All right. So as I look with about 5 minutes to go in today's trading session, we're seeing some buying into the close, kind of a straight line up. We're still just up about 8 on the S&P, still down about 12 on the Dow, 12 points that is, and up 72. So, but again, we are seeing some buying into the close. Megan, what should investors be buying at this point in your view?
So what we've been looking at is those areas that have really reflected a lot of the downside risk. So I would avoid some of those, what they call growth at any price, those very expensive tech growth names. I think there still is some more discovery for them from a valuation and an earnings perspective.
What are those companies? Like, what are some names in that category?
I mean, I would just look at the sector as a whole. I'd be cautious there at the sector as a whole. We have not seen that really decline as much as I would like. I would also focus on those areas like your small and mid-cap stocks that they've been very underloved. We've started to see, aside from yesterday, some bottoming there in the Russell 2000. So I think that you're starting to get some people coming and buying there because, again, they were pricing in worst case scenario down 40-45%. So I would focus on that right now. Wait for the large cap space to wash itself out a little bit more, and then maybe look at some areas there.
Yeah, like the S&P, the Dow, and the NASDAQ, we are seeing investors moving into the Russell too. It's up about 1% right now, Tim.
Oh, look at that.
Well, up and down.
You got me thinking, Carol. I'm pulling up the comp function on the Bloomberg terminal, looking at the S&P 500 versus the Russell 2000, because it's kind of unloved.
Yeah, absolutely. Well, right, we often talk about it. Hey, Megan, what keeps you up at night here when it comes to the investment outlook? And just got about 20, 25 seconds.
Fiscal policy. Leave it right there.
Okay, yeah, that's a lot. That says a lot. Megan, thanks so much. Always fun to check in with you. Megan Horniman, she's Chief Investment Officer at Verdence Capital Advisors. They are a wealth advisory and multi-family office firm, joining us on the phone from Hunt Valley, Maryland.
Funny to hear her say fiscal policy when, monetary policy is also keeping a lot of people up, right?
A lot of policy keeping people up at this point.
It doesn't matter if it's taxes or interest rates. It's keeping people up.
Pretty heavy stuff there. We've just got a few minutes left to go in the trading session. As we mentioned, we are seeing some investor buying into the close here. Still not at our best levels of the session, but definitely off our worst levels. All right, time to head over to our TV colleagues. For Beyond the Bell, live on radio, TV, and YouTube, we're counting you down to the close.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostic, Caroline Hyde, Taylor Riggs counting you down to the closing bell, and here to help take us beyond the bell. It's our global simulcast. We're joined now by Tim Stenovic, and if my eyes don't deceive me, I believe Carol Massar is finally back from her 3-week-long sabbatical across the high seas. We welcome our audiences across Bloomberg Television, radio, and YouTube on a day, Carol, where we saw a lot of buying here at the start of the session.
Yeah.
That faded in the middle of the session, and now as you get closer to the close, those bids coming back in.
Yeah, absolutely. Kind of interesting to see across the board that we're seeing some buying here in the final few minutes. Megan Horniman over at Verdence Capital Advisors was just on with us, though. She's keeping an eye on the VIX, and she said you need to see the VIX, though, consistently to hit 40 to really maybe say we're at the capitulation phase. And right now we've got the VIX at 26 and change, Tim, so not even close.
She also says, get used to what we sideways choppy market until we get clarity from the Fed. But I countered that, it kind of seems like we're hearing that over and over again. We're looking for clarity. The market's looking for clarity, and it's not necessarily getting that clarity. We're always looking for that next eco data point or that next Fed speaker.
And they're getting worse, not better, and which also means that the bond market really isn't providing a lot of the clarity either. Caroline, we talk a lot about the 2s, 10s, and the deepening inversion. The 2s, 30s had some of the biggest inversions that we haven't seen since 2000, as yields on the front end are really going up to the highest that we haven't seen since about 07. So certainly some big superlatives when you mention years like 2000 and 2007 and what it means for this inverted yield curve. 33 bips, Romaine.
All right, well, just an hour or so ago, it looked like we were headed for a down day here, a second straight day of declines, and that's going to buck that trend here. The S&P 500, the Dow Jones, and the NASDAQ all finishing higher. The Dow Jones Industrial Average up by about 0.1%. The S&P 500 higher by about 0.3%, while the NASDAQ Composite is up about 0.7%, and the Russell 2000, not to be left out of the party, up about 0.4% here. So some decent gains across the board, though nothing that's really going to have anybody change, I think, their opinion overall, Carol, about the direction of this market.
Yeah, despite the ups and downs, I agree with you that at the end of the day, I don't think there's anything there to significantly sway us in terms of our views. Having said that, the S&P 500, almost an even split, Taylor, 226 names actually gaining in today's session, 275 to the downside, 2 unchanged. And when we get into the gainers, I know you're going to look at some of that too. There really were some outperformers today, despite the up and down.
Let's get right into that, Carol. I like that you talk about some of the outperformers. It's autos and it's energy. You're up 3% on the day as well. Semiconductors and some technology, hardware, and equipment is up there as well, up about 1% or so. For the radio audience, we also take a look at the sector underperformers as well. It is transportation. We've been talking a lot about some of the rail strike, of course, that maybe Amtrak and the likes are preparing for. That sector off more than 1%. And then real estate in there as well, as we're really continuing to digest what higher yields mean for that sector.
All right, let's get to some of the gainers, the specific gainers in the Wednesday trade. We talked about this, Romaine mentioning Starbucks earlier. This stock finishing just off its highs of the day, up about 5.5%, top in the S&P 500, top in the NASDAQ 100. Company coming out, raising its 3-year outlook for profit and sales. They did this at that annual presentation to investors, also talking about resuming share buybacks in fiscal year 24. So a lot going on with that name. Another one top in the S&P 500 and NASDAQ 100 was Moderna. This, again, we talked about earlier. Reuters reporting that the company looks to have held talks to supply COVID-19 vaccines to China, though no decisions have yet been made, but keeping an eye on that one. And Twilio, some outperformance. Megan mega outperformance, up 10% in today's session, announcing a plan to eliminate about 11% of its current workforce. That drew some support from analysts. Keep in mind, the stock, Tim, is still down about 70% year to date. Yeah.
People getting laid off, and then the Twilio shares higher by more than 10% today. Hey, you got the gainers, Carol. I'll take a look at the decliners. We start today with Union Pacific. Shares finishing the day down by 3.7%. We are keeping a close eye on what's going on with this potential railroad strike. We did learn earlier in the day that Amtrak is suspending long-distance service tomorrow as a result of what could happen with a rail strike. Goldman Sachs saying this afternoon that a rail strike could cost Class 1 railroad operators about $1.8 billion in revenue just for the week. Goldman also said it would contribute to inflationary pressures in the country. I mean, if the oil is being transported by this and it stops, that could be an issue. Nucor, the worst performer on a percentage basis, down 11.3% in the S&P 500. The largest American steelmaker fell short when it came to expectations for the third quarter. It said that metal margins are shrinking and they're seeing shipments decline. Could be a sign of waning demand when it comes to the U.S. economy. And then Meta Platforms finishing the day down by more than 1% today. Shares hit a 52-week low yesterday, fell more today, hitting another 52-week low today at their lowest level since March of 2020, down 60% from their highs last September.
And of course, Tim, Meta has been under pressure because of that inflation read yesterday, because of rates going higher. And indeed, the inflation pressures don't seem to be pulling back that much when you look at the commodity spectrum. Natural gas jumping almost 10% at the moment, lifting over in Europe as well, as we look to Europe trying to tamp down some of the most aggressive parts and trying to cap market prices, trying to stem demand. But at the moment, natural gas certainly pushing higher in the US. And indeed, as you say, oil on the upside, up 1.6%. And this is perhaps we look to maybe an alleviating of some of those shutdowns in China and Chengdu in particular, maybe shorter than had been previously expected. And I mean, overall, having been beaten up so much yesterday, also, of course, talk that maybe the US starts to fill up their reserves again. I'm looking at what happens in the foreign exchange market, because yesterday we were talking about King dollar on top. Today, we give a little, only by 0.2% weakness in the US dollar index. And instead, we see finally some sort of reprieve on the Japanese yen that has been lower, 24-year low. We get a bounce back as maybe the talking, the signaling from Japanese monetary policy makers, the government talking about trying to really push this currency higher once again. Verbal, will it become practical? We look at the British pound up 0.4% as well as their inflation actually dials back a little bit. And sovereign bonds, I mean, again, it felt like it was a move out of debt, whether you be in Japan and New Zealand and indeed Australia. A little bit of buying in Europe, Taylor.
You're seeing, I guess, maybe a mixed picture here. It is stunning, the moves that we're seeing on the 2-year yield after the huge lift up yesterday of about 18 basis points. A continued relentless push higher, 380 on a 2-year yield, up 4 basis points on the day. You're up 3 basis points on the 5-year. And then 10s and 20s are flat. A 30-year yield catches a little bit of a bid. So that is pushing the headline catchy number, 2s, 30s, to the most inverted this century. I guess we'll use the year 2000 to keep it all in perspective. But really incredible the levels of inversions you continue to see.
Yeah, and now this has really gone from just being about Fed policy to really about economic conditions, whether you're betting on a soft landing or betting on what some people now seem to think is a recession, at least by the start of next year, if we're not already in it right now.
Yeah, that's the thing, right? I mean, technically, right? Are we in a recession or not? I don't know.
Do you know how they do that at the NBER? I saw this fascinating documentary about it. It's very clandestine.
What can you share with us?
I don't know. You have to watch the documentary.
There are like 9 indicators, right, that they look at, right?
Yeah, they look at a variety of indicators, and they kind of meet. And it's a pretty high-level discussion, and I know everyone sort of likes to make hay about it, but I think these standards are important, at least from a historical look back, to be able to see when these cycles begin and end.
Well, one of the most important indicators, and I go back to this time and time again, is the labor market. And even though we see this anecdotal evidence, Twilio, for example, especially coming from Silicon Valley, and hiring slowdowns and hiring freezes, I brought this up earlier with Megan Horniman. I mean, the labor market still is just delivering really, really strong numbers month after month. So it's hard until we see some weakness there to sort of think about the fact that
it's
we're
sort of been that drip. We heard from Google earlier today saying that they were kind of getting rid of that area at 120 or whatever, A120 unit. And, I mean, I think it's only like 100 or something, so people that would be affected. But, I mean, it's significant when you add it all up.
Yeah, some of the key innovation areas of some of these companies really starting to dial back a little bit. And there has been some great pieces by Tyler Cohen, for example, our opinion writers saying really you should be worrying about the US workforce. That's a bigger problem at the moment. You pointed out yesterday it's about a white collar issue that we're going to see first and foremost. How quickly that starts to dial up into the market at the moment, because wage price spiral is still very much something that we're trying to address, that people are worrying about at least.
The only caveat to that, we were talking to a private equity guest today saying they've only cut valuations on their end by about 5%. They're not really having to tell their portfolio of companies to hoard cash, that margins on that end have been stable. Now, of course, that's just other anecdotal evidence, and we'll look for the real data as well, but you certainly are hearing both sides.
All right, so 1 month from today, we will get earnings from JP Morgan. So I'm starting to think about, let's get through that Fed meeting, right? There's obviously economic data points, but now what will be the next kind of layer of conversation that we get from the C-suite specifically about cutting back margins? I mean, that's kind of what I'm starting to think about to get an idea of what's next for us. Are we going to hear a lot of recessionary talk from CEOs, Tim? I mean, I'm thinking a lot about that.
Well, look what we got from the Business Roundtable earlier when it comes to CEO sentiment. I mean, I think that gives us a little preview of the types of commentary that we're going to hear from these CEOs when they start to report earnings and say, hey, we're holding back on hiring, we're holding back on CapEx spend because we're concerned about the economy.
Yeah, exactly. Think about what McDonald's said today and the CEO. So, all right, guys, we got to run. That's a wrap for our cross-platform coverage. Beyond the Bell, live on radio, TV, and YouTube, counting you down to the bell. We will see you again, same time, same place, tomorrow.
You're listening to Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
It's like deja vu all over again.
Is it Yogi Berra? Did he say that?
I think so. I mean, this is kind of the environment we're in right now. I think it is pretty optimistic that we saw some buying into the close. I mean, think about the story we talked about, Cathie Wood.
Yeah.
You know, doubling down on some of her bets, selling some of her winners. We talked about the individual investor really coming back into the market in a big way. If you believe in fundamentals of some of your investments, you know, they've been on sale, or they went on sale yesterday.
The question is, do they get more on sale?
Correct.
You know, in the next few months.
Could.
Last week, Scott Meinert of Guggenheim said that, I know you were out, 20% decline is what he sees coming this fall.
I did actually see that headline. Yeah. Well, that's interesting. And, you know, somebody's going to be right. That's all I'm going to say when it comes to what happens
And
next.
we'll get to talk about it.
We will indeed. Keeps us busy. All right, now, let's get to world and national news. Lots to talk about. Nancy Lyon is on it from D.C. Hey, Nance.
Thanks, Carol. Members of one union are rejecting a tentative deal with the largest U.S. freight railroads, while 3 other unions remain at the bargaining table with the national strike deadline of Friday. A strike would intensify snarls in the nation's supply chain that have been contributing to rising prices. Amtrak has already canceled all long-distance trains beginning tomorrow. Well, President Biden says America's roads are being electrified. He announced today at the Detroit Auto Show some of the new investments in electric vehicles.
We have never been in a better... And part of the infrastructure law, we're investing $7.5 billion to build electric vehicle charging stations all across America.
Biden says EV chargers will cover 53,000 miles of highway across 35 states. Well, some good news on the pandemic front. The head of the World Health Organization says global COVID deaths last week reached their lowest point since March of 2020. And WHO Director General Tedros Ghebreyesus believes we've turned a corner.
We have never been in a better position to end the pandemic. We're not there yet, but the end is in sight.
Tedros Ghebreyesus urged countries to continue their work to contain the virus. Mourners are filing past the coffin of Queen Elizabeth II. The Queen will lie in state for 4 days until the late monarch's funeral Monday. With hundreds of thousands of people expected to file past, the coffin is draped in the imperial standard with the imperial state crown sitting on a velvet pillow. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, you are listening and watching Bloomberg Business Week. Carol Massar along with Tim Stanovic. A couple stories that we wanted to bring to your attention. There's a lot going on.
You want to talk Spencer Soper's Amazon story?
Yeah, let's do
this
it.
This is a really interesting one. Okay, so Amazon is making a risky pivot to email marketing amid slower sales. It's going to let brands and merchants send marketing emails to shoppers. This is a risky bid to boost sales that could inundate inboxes with spam.
Oh, goody.
You want to hear something weird?
This makes me nuts. What?
We got a random Amazon package addressed to my wife with like a children's book and some kids' Band-Aids and some like soil.
What
we don't know who it's from. We got in touch with Amazon, gave them the tracking number. Apparently this is a thing. And they're like investigating. They said for privacy reasons, it's an unregistered Amazon account. We can't tell you who sent this to you.
Is it a marketing thing?
Well, there are some like kind of scams that happen with different things being sent to people.
That's kind of creepy.
It's really weird.
I don't want people sending me things that I
Kept the Band-Aids. Is that weird?
What do you do with the soil?
Threw the soil away.
Did you?
Well, we don't need any soil.
Was the kids' book good?
I don't remember which one it is. It's really weird.
Well, anyway, Amazon announcing the initiative yesterday at the Amazon Accelerate conference in Seattle, where it demonstrates new features to the independent businesses that sell more than half of the products on Amazon.com, which you are reminded when you buy stuff, right? It's not all coming from Amazon directly. It's from a lot of its third-party sellers.
Do you want those emails?
No. Do you?
Well, Amazon for a long time realized that we don't want those emails. The move marks a break with Amazon's historic reluctance to let independent merchants connect directly with customers for fear of alienating them.
Yeah, they say despite some of the risks and what?
I don't think people realize who they're buying from on Amazon. It says who it's sold by.
I always look.
Well, there was that investigation a few years ago that the Wall Street Journal did.
Yeah.
That I think got a lot of attention, a lot of people's attention. But still, I don't know what these emails are going to look like.
I don't know. I just don't want more stuff. It's just more stuff that I won't read.
Yeah,
and then my family looks at me and they're like, you have 15,000 emails. What is your problem?
Mom, why aren't you writing me back?
That's why when somebody legit is like, didn't you see my email? Like,
No.
No. All right, Carol Massar, Tim Stanovic, and this is Bloomberg.
Facts, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Choppy session, but in the end, a move higher for the Dow, the S&P, NASDAQ. Today we saw the S&P up 13, a gain there of 0.4%. The Dow up 30 points today, up 0.1%. NASDAQ up 86. That was a gain of 0.7%. Stocks rebounded in late trading a day after that hot inflation report sparked the biggest rout in more than 2 years. Yesterday, you recall, the S&P plunged by 4.3%, but today a move higher. 10-year yield 3.40%, the 2-year yield 3.79%. Spot gold 16.96 the ounce, drop there of 0.4%. West Texas Intermediate crude up 1.7% today, higher by at 88.78 for a barrel of West Texas Intermediate crude oil. PayPal CFO Blake Jorgensen is taking medical leave. That headline right now from the Bloomberg Professional Service. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, nice catch there. Charlie Pellet there with a Bloomberg Business News Flash. Well, YouTube, come on, you know what it is. It's ubiquitous.
Never
really.
heard of it, Carol.
How often are you on it every day? I know I'm on it a lot. We all check it out. Tim and I are in our Business Week show. I mean, we're on it right now. And there's a new book out that really looks at the inside story of YouTube and really its impact on every aspect of our world.
Yeah, we're really grateful to have with us Mark Bergen. He's technology reporter for Bloomberg News. He joins us from the Bloomberg 960 studio in San Francisco. Hey, Mark, congratulations on the new book. Carol, while you were out, I got the chance to actually meet Mark in person. He was here in New York City last week, and we were supposed to have him on, but then we had breaking news with the Queen. So we appreciate Mark joining us once again here. Mark, again, congrats on the book. Take us through the moment you realized that you needed to write a book on YouTube. What was that catalyst?
It was, funny enough, it was a really dear friend of mine who was a high school teacher, and I've been reporting on the company and the platform and a lot of its content moderation difficulties and the complex world of YouTube stars and celebrities, and I was talking to him about it. And he's sort of out of media and tech altogether, but I was telling him about PewDiePie, who at the time was the biggest YouTuber in the world, and he said, like, oh my God, my high school students who I went on this camping trip with in the middle of the wilderness, they wouldn't stop talking about this YouTuber and how they were obsessed with they were missing him, they wanted to go back and watch him, and that was a moment where I was like, okay, here's someone who is disconnected from this world professionally, but deeply interested in this topic. He's also a parent of a young child, a 3-year-old at the time. It was like learning nursery rhymes from YouTube videos. So it was an example of like how pervasive it was, and I thought a really good opportunity to hopefully peel back the curtain a little bit.
Mark, how much of it was right time, right place, right technology, that this was actually able to come to be and be so impactful on our world overall?
A fair amount. I mean, I think they made some really important decisions early on, and so they're as a startup, they only existed for about 18 months before Google swept in and paid them for a cool $1.6 billion.
That was huge at the time, Mark.
First of all, it was, yes. And it was a profoundly easy. It's still like the basic feature set of YouTube is pretty much the same as it was 17 years ago. It is simple, it's intuitive. Like the founders talked about building something that their moms could use, and they certainly succeeded. They were one of the first digital video sites to build in a feature where they could embed in other websites and players, which was pretty revolutionary at the time. They also took some risks that bigger companies, including Google and Microsoft, wouldn't take around copyright, which ended up paying off for them. It got them into like big, messy legal challenges. So I think there were a lot of key decisions they made, and then it was like this moment where there was just this explosion in interest in homemade video, and like clearly video was just moving to the internet.
I think what's so interesting about this is, in the early days of YouTube, there was this really sort of reluctance from coming from media companies to work with it. It was kind of seen as like this disruptor that they were really scared of. And now what you have is you have the large established media organizations using YouTube as a channel for distribution. Mark, can you talk a little bit about how they sort of turned from, enemies to, I guess, frenemies Emmys, and now kind of like everybody needs to be on YouTube?
Yeah, it was a long battle. I mean, the early business teams at YouTube were very focused on getting traditional media to come on to the platform. And part of that was a concern that this was the only way they were going to have commercial success. If they can get, I talk about in the book, they went out and they tried to cut deals with CBS and ABC. And it got pretty close with both of them, like to run Lost, which was like the biggest show, or one of the biggest shows in America at the time, on YouTube. A lot of those companies instead went and they formed Hulu, or they eventually built their own streaming services. And some of, Disney is a good example, was reluctant to put its prized IP onto YouTube. Still to this day, you're not going to find like they're going on Disney Plus, they're going in movie theaters. But to your point, this was the audience was there sort of since day one, and it's been sustainable. YouTube put in place a rights management system that's basically if even if someone else uploads a piece of Disney content, Disney gets the money from the ad revenue, and that was a pretty key decision that they made, and that helped persuade record labels and traditional media to come on. YouTube was at one point competing with them. They started a few years ago, an originals, building in subscriber-only shows. They've dropped that. They're like, we're content to be the sort of video advertising platform. Let Disney, Netflix, Amazon battle it out for subscribers.
Okay.
I think that's a big, you've seen media companies be more comfortable with them since.
But this is what's so weird. I remember a few years ago when YouTube did this, I forget what it was called, like a YouTube, it's not YouTube Premium. Was it YouTube Red, Mark, maybe?
It started off as YouTube Red, which was a very clumsy name.
Yeah. But Cobra Kai was like one of the shows that they talked about a lot, and nobody watched it when it was on YouTube, but then it went to another platform, and now everybody talks about it.
And it's, YouTube does, it's part of Google. They have gobs of money. They're Alphabet, but at the same time, like and more recently, we reported on this a lot for Bloomberg, like they have been cutting back on spending. And I think, the originals program that launched Cobra Kai, it was sometimes in tension with the other goals of the platform, which is just scale, get a lot of people, a lot of watch hours, build out this sort of advertising company and operation. I think you could make an argument that had they invested more resources into original content, they could be cranking out more of the Cobra Kais. Google as a company just doesn't do media programming. It's not what they excel at. They're not comfortable there. They're a company run by engineers, and they've been clumsy at that in the past. And to be frank, like I cover this a lot in the book. Like they went out with the originals plan was we're going to not just have Cobra Kai, but we're going to have our biggest YouTube stars in these shows. And then some of their biggest YouTube stars went out and did like deeply irresponsible things that got them in trouble with advertisers and politicians. And I think that was a contributing factor to, okay, maybe we can't take these risks with these creators.
Well, God, there's so many questions I want to ask you. I'm looking at your book, and you talk about, for years YouTube had been scolded for giving a platform to radical Islamists. And I do think about the political side of this and the controversy, and this gets to what is YouTube? Is it a media company or, a media arm of Google? But talk to us about some of the controversy that has erupted over the years, especially as YouTube has become, so ubiquitous in all of our lives.
Yeah, I mean, remember an early moment it's the macaca moment is what it was called, and it was a Senate race in Virginia where a candidate said something deeply racist on camera. That spread. It was one of the early first kind of YouTube political viral hits, and it changed the race. I think leaning in, the book talks about the Arab Spring, which was a very different time for social media companies when they were seen as they were toppling dictators, right? YouTube did at the time invest in a partnership around verifying footage coming out of the Middle East and the Arab world. I think for a variety of reasons, like the companies kind of their DNA, they are risk averse. They didn't want to get into legal trouble. They were more hands off on taking editorial approach, especially on politics. And then fast forward to the Trump era, they've been extremely cautious. Politics is effectively radioactive for YouTube. The answer that Susan Wojcicki, the CEO, has talked about is that news and politics is a relatively small percentage of the platform, which in some ways is true, right? You go look at YouTube, it is gaming, it is beauty, it is kids content, right? Music videos. Relatively speaking, it is news and politics is small, but everything in YouTube is big just because of the scale of the platform. So they have many of the same issues that Twitter and Facebook have dealt with the added wrinkle of YouTube is built the creator economy. And in many of these channels, they're not just broadcasting them; they're sharing ad revenue and their business partners.
Hey, Mark, just got a couple of minutes left here. In doing this, and you've reported on this company, for a long time. What surprised you, or what came to light that you were like, "Wow, I didn't know that"?
Some of their early success was actually. Their early success was based on MySpace, which is really funny now if we think about. MySpace was the hottest thing.
We remember Tom.
That was kind of surprising to me. Yeah. YouTube, they built the world's biggest kids entertainment platform, and it's a multi-billion-dollar business now, right? And they're like huge conglomerate companies coming out of Hollywood that are just around YouTube kids content. What surprised me was the extent to which the company had turned a blind eye to that and really didn't expect that to happen, and for a long time didn't know how to deal with that. And I think just in the past recent years, after they've been regulated and a lot of attention focused on that, they're finally turning to, wow, we have some responsibility here with where we're raising an entire generation of kids.
Hey, Mark, what does the future of YouTube look like? I think about what encompasses increasing amounts of time for people who are using mobile devices, and I think of TikTok, and we see the way that Facebook and Meta platforms have responded to TikTok. And YouTube has these like YouTube Shorts, right? Trying to get people to be like TikTok-y. What do we expect them to do to try to compete with TikTok?
Certainly leading in on Shorts. They have plans to, I believe by the end of the year, turn on monetization and commercials for YouTube Shorts. And I think you talk to creators and they're really jazzed about TikTok. TikTok is a place where they can break through to an audience in a way that YouTube is very crowded now. That being said, almost consistently, it's like, well, I can have fun, I can experiment on TikTok, I can reach a big audience, I really make money on YouTube. And so I think once YouTube's able to turn on flip that switch, it's going to have a bigger competitive advantage against TikTok and against Facebook, which has never really figured out how to monetize creators in that way. YouTube's also, their big focus is still like eating into the television market. And so I think we will see them increasingly try to capture more time on big screens.
Mark, bottom line, it's not just about cat videos, right?
Yeah, exactly. That was the subtitle at one point.
Of course it was. Mark Bergen, congratulations, and thanks for finding time for us. Tech reporter at Bloomberg News, there in our 960 studio in San Francisco. His new book, check it out. Like, comment, subscribe. Inside YouTube's chaotic rise to world domination. It really does dominate the world when I think about how often we go to it.
I like that he went with that title and not it's not just cat videos anymore.
Come on, cat videos would have been funny.
Really great to chat with you, Mark. Thanks so much for joining us. Well, let's get on over to Charlie Pellet because it's been a half hour since the bells, but man, there is a lot of news.
Indeed, a choppy session today, wild session, wild finish, and that's why you always got to keep it locked into Bloomberg to find out what happens as we move into the closing bell. But today, the S&P turned around. We actually had a 13-point gain today for the S&P, up by 0.3%. Keep in mind, yesterday, the S&P plunged by 4.3%. The Dow today also turned around into the close, up by 30 points, a gain of just about 0.1%. NASDAQ also had an up day, up 86 points today. That was an advance of 0.7%. Stocks rebounded a day after that hot inflation report sparked the biggest rout in more than 2 years. The 10-year yield, 3.40%. The 2-year yield, 3.79%. Spot gold down $5 the ounce to $16.97, a drop there of 0.3%. West Texas Intermediate crude today up by 1.8%, 88.88 on WTI. Railroad stocks lower today ahead of a possible Friday strike. Today, Union Pacific dropped 3.7%. Those talks are ongoing. CSX down 1%. Norfolk Southern lower by 2.1%. So bottom line, choppy session. What's ahead for markets? Megan Horniman is Chief Investment Officer at Verdance Capital, and she was our guest right here on Bloomberg Business Week.
You're going to see a lot of this choppiness. It's just going to be an ugly market over the next week. The market's just waiting for that Fed report. And then even between now and then, we have quite a bit of economic data to digest. So I think you're just going to see a very sideways, choppy market until we get a little bit more clarity on exactly what the Fed's going to do.
Oracle shares had their worst day this year, snapping 2 weeks of gains after a Berenberg analyst initiated coverage on the software company with a hold rating. Today, Oracle was down 5.2%. Coming soon from Walmart, the world's largest retailer, checking accounts. Walmart shares down today by 0.2%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much, Charlie Pellet. You are listening and watching Bloomberg Business Week on this Wednesday. Carol Master along with Tim Stenovic. And our next guest works at the world's biggest brewer, maker of Budweiser and Corona. He has spent nearly 20 years at the company, has some thoughts for us on today's marketplace and what consumers want. He's also the former global president of AB InBev's Beyond Beer division, so we can talk about a lot with him.
Very pleased this afternoon to have Marcel Marcondes with us. He's Chief Marketing Officer at AB InBev. He's with us in person in the Bloomberg Interactive Brokers studio. It's really nice. How are you?
I'm very good, thank you. It's so cool to be here. Thanks for having me.
Yeah, we love having you here. Marcel, I want to just talk about the global outlook here and what you're seeing. I mean, you guys operate in so many different countries, so you have a really good idea of what's happening on the ground. The world's struggling with inflation. There are concerns about the economy here in the U.S., around the world. What are you seeing?
Yeah, I'm seeing that although everything you just said is absolutely true, of course, and we all feel it. There's another big force having a big impact in how we behave and in the economy as well. I really believe in that. Like, hopefully we're getting out of this COVID thing. So especially when you think about our business. Hopefully, yeah. You can never affirm it because there can always be a new variant showing up anytime, knock on the wood. But anyway, especially for our business, for the beer business, it's very meaningful to see that people are really willing to go back to life. Right, to enjoy, to be outside, to enjoy concerts, to be with friends, to be with family, to have a good time, to feel like they can enjoy time together one more time. This has an impact on the economy. This has a significant impact in our business as well. You can imagine all the frequency on restaurants, bars, events, or all those things that were not happening anymore. So there's a balance, long story short, in terms of points of concern, as it's always the case in life, but a lot of points for optimism as well.
Do you feel like you have a lot of clarity and in terms of the outlook? And it's interesting that you talk about events. Tim and I did a couple of shows from the U.S. Open here in New York City, and I mean, it was packed. And people were eating, people were drinking, people were enjoying, people were shopping, people were enjoying incredible tennis. But it does feel like, and it was so packed compared to where it was pre-pandemic. Like, people are just starving, it looks like, to do things.
It did set records, Carol.
It did set records, right?
It's the most attended U.S. Open.
So having said that, do you feel like the economy is stronger versus like all of the recessionary talk that seems to be going on globally?
Yes, and I am optimistic. That's exactly how I feel, especially for our segment, for our industry. I am optimistic. I think there's a lot of bright side, a lot of bright angles for us to observe, like the ones you just described. People are out there. There's always a key concern about inflation, recession here and there, but there's a bigger inner voice and energy saying, go live. Let's talk about something different, like travel. Right. Like you all, for sure, you've been traveling, you've been going to airports, they're all packed, right? There's somehow crisis because of lack of staff on the airlines and stuff, but people are moving.
Yeah.
Right. So there's definitely some reasons for optimism as well.
Well, it's interesting hearing you speak this way because obviously your job is to tap into what people are feeling because you need to know how to communicate to them. You need to know how to express your brands to them in a way that they will be receptive to. How has your communication, AB InBev's communication, changed over the last couple of years? Like, what is the message that you are sending right now? And I know this varies depending on the market, but how would you characterize it?
That's a very good question. And actually, I should take one or two steps back before I get really straight into your question, because I think we as a company, we're going through a meaningful process of evolution. We're known for our financial discipline and for growing inorganically. But then in the last couple of years, to your question, we became the indisputable #1 brewery in the world. And by the time you become the #1, you lead the category. So your growth model needs to adjust. It needs to evolve, because it's not about acquiring other companies anymore and just fighting for share. You need to work to enlarge and to grow the whole category so that everybody wins and you win together. Meaning, we need to move from a growth model that is focused on inorganic growth to a growth model that is focused on organic growth. And by the time any company makes that decision, brands become inevitably one of the most important assets of the organization, if not the most important ones. And this is when we really talk about our messaging and all that. So we are intentionally becoming much more consumer-centric, and this is for real. It's not just a nice thing to say. So we became obsessed about talking to people, understanding what's going on with them, what's impacting their behaviors, which are their needs, so that we can identify relevant opportunities to make our brands relevant in their lives. The key thing is that when you do marketing, when you build brands, there's a trap or a tendency for people to be okay just if they're visible. And then you can spend a lot of money just on visibility. The key thing to really drive growth and to be meaningful to people is when you find the right spots to be relevant to them.
How do you figure out relevancy in
It all comes as a consequence of being close to them. So we talk to literally millions of people every year. We have
surveys. Like, what do you do?
We have online panels and fixed online panels. We talk to thousands of consumers every week. We talk to millions of consumers on a given year, because we're obsessed about understanding their behavior, their needs, and the changes in their routine. We learned a lot of that coming after COVID, right? Because when a big thing happens that significantly changes the way people live, we need to have a much tighter pulse on how they're living, so you can identify the opportunities to be meaningful and relevant in their lives. And that's a big change that we've been going through as an organization.
Sit tight for a second, because I also, and I know Tim, because Tim, you drink a lot of non-alcoholic beer.
Yeah, we're going to talk about that on the other side.
We want to get into the idea of, like, what are the trends moving forward? As you guys, you talk about organic growth, but how do you kind of shift to make sure that you're meeting what consumers want? We're going to come back with Marcel Marcondes. He's Chief Marketing Officer at AB InBev. Lucky for us, he is here in our Bloomberg Interactive Broker studio. Our conversation will continue in just a moment.
Yeah, it's a company behind Budweiser, Bud Light, Stella, Patagonia. I mean, their list goes on, literally hundreds of brands. Meantime, let's get a check of world and national news. For that, we go to Nancy Lyons in D.C. Hey, Nance.
Thanks, Tim. President Biden spent some time today in Detroit for the auto show and said he's promising cleaner cars in the future.
The Great American Road Trip is going to be fully electrified. Whether you're driving coast to coast along I-10 or on I-75 here in Michigan, charging stations will be up and easy to find as gas stations are now.
Biden has announced approval of the first $900 million in infrastructure money to build EV chargers across 53,000 miles of the national highway system in 35 states. Sweeping sanctions against Russia have cost the country hundreds of billions of dollars. That's according to an internal finance ministry document, which found there have been significant hits to the stock market, bank capital, and foreign exchange reserves that were frozen by the restrictions. Russian President Vladimir Putin gave officials an upbeat outlook on Monday, saying the nation is, quote, heading for a growth trajectory. The special counsel appointed by former President Trump to look into the origins of the so-called Russia probe is apparently winding down, as we hear from Bloomberg's Nathan Hager.
The grand jury convened by former U.S. Attorney John Durham has expired, and sources tell the New York Times he has no plans to call another one and is working to finish his final report by the end of the year. Former President Donald Trump and his supporters had hoped the special counsel investigation would prove a deep state conspiracy to undermine his 2016 campaign. Durham has developed cases against two people accused of lying to the FBI, but has not brought any conspiracy indictments. In Washington, I'm Nathan Hager, Bloomberg Radio.
Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
Thank you so much for that update, Nancy Lyons. Tim Stanovic and Carol Massar live from the Bloomberg Interactive Broker studio. I want to get back to Marcel Marcondes, Chief Marketing Officer at AB InBev. He's with us right now. And we were talking before, during the break actually, that because there's so many brands at AB InBev, 500, some 500 brands, I was asking you how this is structured internally, because you can't personally oversee 500 brands. So take us inside the company a little bit.
Okay, so welcome to the. I was about to say welcome to the kitchen, but I'd rather say welcome to the bar, to the brewery.
Works for us.
To the brewery. All right. Basically, I have heads of marketing responsible for the different regions of the world, and I also have people reporting directly to me to lead from those 500 brands with the 4 global brands. These are the brands that really have gigantic global scale, and they are Budweiser, Stella Artois, Corona, and Michelob Ultra. So there's a special focus there, plus the long tail of brands, because this is still an industry where 50-ish% of the industry is focused still in local brands. So beer is so connected with culture, right? So in the different countries, we have powerful, big local brands that are extremely meaningful, because on top of being strong beer brands, they are heavily connected with the local culture. They usually carry the local pride, you know.
Right, that makes a lot of sense. I mean, do you anticipate that those 4 brands continue to be really kind of the engine for the company going forward? Or from what you're seeing with consumers, are tastes going to change maybe significantly? And only got about 30 seconds, and then we'll come back and talk more. No, you can talk now.
Yeah, okay. Oh, yeah, definitely yes, because these 4 brands, they are premium brands.
Yeah.
And the premiumization is a gigantic trend that we see having a huge impact in multiple industries, including ours. It's here to stay. So for sure. Basically, we have 3 main segments. We have the big core brands, and this is where we have the local brands.
Right.
And this is a huge part of our business. Then
hang on, Marcel. We're going to come back and talk some more. We're going to continue with the CMO of AB InBev in just a moment, right here on Bloomberg.
Facts, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Bloomberg World Headquarters. I'm Charlie Pellet. PayPal Holdings says Chief Financial Officer Blake Jorgensen is taking a leave of absence to address a treatable medical condition. He took on the role last month. The Dow, the S&P, NASDAQ all advanced today. Choppy session with the S&P eking out a 13-point gain today, up by about 0.3%. We did see a rebound late in the day. This after hot inflation yesterday sparked the biggest rout in more than 2 years. Yesterday, the S&P plunged 4.3%, but today up by 0.3%. The Dow up 30, a gain of 0.1%. NASDAQ up 86, a gain there of 0.7%. Two-year yield 3.78%. The 10-year yield 3.40%. Spot gold 16.96 the ounce, while West Texas Intermediate crude was up 0.5%. Today we had WTI actually up 1.9% at 88.98 a barrel, rallying today by $1.67. So again, to be clear, West Texas Intermediate crude up 1.9%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. We want to get right back to our guest. Still with us is Marcel Marcondes. He's Chief Marketing Officer at AB InBev, formerly the Global President of the company's Beyond Beer division, still with us in our Bloomberg Interactive Brokers studio. We had a fun conversation while Charlie was giving us an update. What are the top brands that sell in the United States?
I'll give you the top two, okay? So number one is not going to be hard to guess. It's Bud Light, and it's been the case for decades. But number two might be new news for you. Number two is Michelob Ultra. Low carbs, low calories, great taste.
It's been around for 20 years, though.
It's been around for 20 years, and since last year, it's the number 2 brand in volumes in the United States.
Tim, you were shocked by that.
Yeah, I was really surprised because to me, it's still a new brand. Even though it is 20 years old, it's one of those brands that I think I remember when it was introduced. How has it been so successful, and why, especially in the last year, has it seen a real uptick?
I think, again, it's all about getting extremely well connected with consumer behavior and with big consumer trends and industry trends. In this case, we see that health and wellness is a big trend. We see this in every industry, right? And for sure, COVID has accelerated that as well. People became more and more health conscious.
Yeah.
So we see a clear impact of this in our industry too, and this has definitely accelerated the performance of Michelob Ultra.
Marcel, that's what I wanted to ask you. Like, Tim and I, for so many of our conversations for a long time, and I do feel like we're getting increasingly away of thinking about the COVID impact, but what happened to you guys during COVID that has stayed with you in terms of corporate strategy and how you relate with consumers?
No, that's a very good question. So when you think about brands and commercial trends in the industry, I could name 3. So the first one, as we just spoke about, is health and wellness. Mm-hmm. For obvious reasons, people became much more health conscious. This has an impact on everything. In our case, we feel it. We'll feel the same. There was a very nice acceleration of Michelob Ultra, for example, as a consequence of that. Second point is premiumization, because beer is affordable luxury. Right, so when people say like, okay, things are complicated, I want to give myself some treat, and then they can afford great beer. So we see premiumization. Again, this is a trend that we see happening in multiple industries, but in our case, in the beer industry, it's a very evident and strong trend. So back to your previous question, on the global brands, they're all premium, and they continue to be the big growth engine of the company because they're sitting over a gigantic trend for the industry. The third thing that I think we all feel it in our daily lives is e-commerce. Because of the lockdown lives, people started getting used to buying things online. And for us, it's happening as well. So we've been investing significant amounts of money on technology, on building those platforms. And for example, another point that is probably going to be a curiosity for a lot of people, more than 50% of our net revenues, they are already sold worldwide via digital channels.
How does that work for beer?
Yeah.
Right?
How does that work?
So
we know
this is because
Drizzly and like those shops, but
this is sold from us to the clients, to the retailers, right? So to the on-trade. So this is our business to business.
Okay.
This is our business to business platform called BEES. It's already one of the top 10 e-commerce platforms in the world. But imagine a company our size, more than 50% of our net revenues are already sold via digital channels.
What about direct to consumer?
Direct to consumers, thanks for the question. This is our next endeavor. So we have already in a few countries.
So Tim's going to be able to get his Michelob Light. Just click on it.
Michelob Ultra.
Yeah.
Ultra. Sorry.
So in the U.S. Specifically, we have strong partnerships with the big retailers that also have online versions like Walmart and so on and so forth, and Drizzly and the ones you mentioned. We cannot operate in the U.S. doing direct to consumers operations, but in multiple countries of the world we can. In Brazil, it already represents more than 5% of our total sales. We sell direct to consumers there, and we're just about to launch. Like FIFA World Cup will be a big opportunity for us, especially in Latin American markets.
Right.
Because imagine how many people will be watching the games at home and feel like, oh, I should have ordered more beers. So we're launching Tada.
Or I've already had a 6-pack and I can't go out, so
Yeah.
I'm just kidding.
So we're launching Tada, right, which is our new global brand for direct to consumers in more than 10 countries in the second semester of this year, and this is growing very fast.
Marcel, are beer trends among consumers? I mean, this is probably a stupid question, but I mean, are they the same? Like, do the trends that change, is it the same, or different markets and what consumers want are different? Like, how different is it?
Some trends are some things they hit
like the wellness trend, is
the
that
different
everywhere?
markets with different intensity, but they're the same. Like the mega trends, as we say, like premiumization, health and wellness, e-commerce. These are mega trends. But for example, beyond beer is something that is not equally split yet. So you see, like the U.S., for example, having a very meaningful market already for beyond beer. I mean, seltzers, ready-to-drink cocktails, hard teas, and these kinds of products.
Right.
It's already 10-ish% of the total industry in the U.S. It's very sizable. In other markets, it's still more at the early stages. So this is one trend. It is a trend everywhere, but it's still unevenly distributed. For example, this is what brings a lot of female drinkers. You were asking me offline about it, right? So it brings a lot of female drinkers into the business, a lot of younger consumers into the business. It's growing a lot. We used to say it's inclusive, incremental, and profitable, so it's a great business to be part of.
When people say non-alcoholic beer, do you like, oh my God, please don't say that? Or do you say, okay, we're in it?
We learned something from experience. Like if you want to say that we are consumer centric for real, we can never say, oh no, don't talk to me about it. Because if consumers are looking after those solutions, we need to be best in class in giving it to them. And non-alc is a trend as well because it is connected to health and wellness.
What's the growth you're seeing in non-alcoholic?
We're seeing double-digit growth.
But it's coming from a small base, right?
Yes. In the U.S., for example, it's around 1% of the industry. In Europe, it's closer to 10, between 5 and 10, so it's a different kind of conversation.
Right.
But it is growing everywhere.
What's your brand? What are your brands that are non-alcoholic?
We're the leaders in the US, for example. We have Busch Non-Alc, we have those Non-Alc, but our leading brand in terms of growth now, because it's more recent, is Bud Zero. 50 calories, no sugar, 0.0 alcohol. It's a very modern liquid. We just launched Stella non-alc in Europe. We're piloting this in the US now, and the heavy hitter that we have now is Corona Zero. We have in multiple markets in Canada, in Europe. We're starting this in Latin America as well, and it's amazing because for you to have the taste of a real Corona with the lime, whenever you're looking for a non-alc proposition, it's just irresistible.
All right, it's been a rough day, a rough week, a rough month. What's your drink of choice?
I always have my Michelob Ultra at home, my Stella at home, and my Cutwater at home as well, which is a ready-to-drink cocktail that is just amazing.
All in one night?
Sometimes, yes. Why not?
He's
right?
got to do it for work, Carol.
It's
part of his job.
That's
Yeah,
right.
okay.
Making sure you know your product. This was fun. Come back.
Please.
Really enjoyed it.
Thank you so much.
Marcel Malcondes, he is Chief Marketing Officer at AB InBev, and lucky for us here in our Bloomberg Interactive Brokers studio.
It's good to have you back, Carol. Welcome back.
It's good to be back. It would be even better if we had a Michelob Ultra.
All right, let's go. We'll get one.
Next time. This is Bloomberg.
heart of where innovation, money, and power collide. In Silicon Valley and beyond, this is Bloomberg Technology with Emily Chang.
San Francisco, and this is Bloomberg Technology. Coming up in the next hour, social media executives in the hot seat on Capitol Hill, current and former employees from YouTube, Meta, and TikTok, taking questions about privacy, security, and misinformation. The question remains, how do regulators get ahead of a rapidly evolving social media landscape? We'll have more on that in a moment. Plus, the Ethereum merge is closing in. What does it mean for the blockchain and the crypto landscape at large? That later this hour. And the trial of Nikola founder Trevor Milton is heating up, with a former contractor turned whistleblower telling a jury he made $600,000 by contributing information to that short report that spurred Milton's downfall. We will have that story. First, though, I want to get a look at the markets. Tech stocks rebounding, outperforming the broader market. The push higher coming a day after the biggest sell-off in more than 2 years, as hotter than expected inflation data makes next week's Fed meeting that much more consequential. Bloomberg's Ed Ludlow here with the biggest moves. Ed, a sigh of relief today.
Yeah, a little bit. There was a bit of tug of war in the market on Wednesday. Everyone's trying to make sense of what that inflation print means for Fed policy going forward. But the tech-heavy NASDAQ 100, a real outperformer among major indices, up 0.8%. Semiconductors also doing well as well. The Philadelphia Semiconductor Index, or SOX, up more than 1%. If there was an area of weakness or sustained pressure, it was in Bitcoin, which holds below that $20,000 per token level, which it breached 24 hours ago. We are thinking about what happens next, right? Look at this terminal chart. The policy-sensitive 2-year continued to push its yield up throughout Wednesday's session. You see that big jump in the yield on the 2-year Tuesday, coinciding with that big drop of the NASDAQ 100. And this is where it's all playing out. This is where we're keeping our eye ahead of that key Fed meeting next week. In terms of the key movers, of course, there's a big news cycle going on in the background. We forget that there's a lot of movers on the move. Tesla, actually one of the best performers, despite basically negative headlines. The first, that there's a lawsuit that's hit Tesla claiming that it's deceived car owners about its car's self-driving capabilities. Also reports out of Germany that an expansion of their factory near Berlin has been put on hold. Interesting to see some pressure on some social media stocks as well. Of course, former executives speaking to senators about what they think needs to happen in the regulatory landscape. How often are we having this conversation, Em? Often, though, not pressuring the stocks. It's hard to draw a causal relationship here in the market, but some social media names, a pocket of weakness this Wednesday.
And that has been a pattern, Ed. Thank you. We'll see you later in the show. Well, for the first time, as Ed mentions, top execs in charge of product design and operations for Meta, YouTube, Twitter, and TikTok all testifying on Capitol Hill. Before they were even questioned, though, a panel of former executives testified about prioritizing growth over moderation. They were all questioned during the Senate hearing with the Homeland Security Committee about online extremism and user protections. Many of the answers from the current employees were open-ended. Take a listen to this back and forth between Senator Rob Portman and TikTok COO Vanessa Pappas.
Can you make the commitment, though, that I just asked you to make, that you will commit to cutting off all data and metadata flows to China, Chinese-based TikTok employees, ByteDance employees, or any other party located in China?
What I can commit to is that our final agreement with the U.S. government will satisfy all national security concerns, yes.
But you won't make a commitment to agree to what I have now twice asked you about?
Sorry, given the confidentiality of CFIUS, I'm not able to talk specifically about that agreement.
I'm not talking about CFIUS. I'm asking whether you'd make that commitment today.
Here to discuss, Techonomy CEO and editor-in-chief David Kirkpatrick, as well as Bloomberg's Alex Barinka, who covers social media for us. So, Alex, let's start with the big takeaways, not the least of which was Vanessa Pappas's exchange there with Senator Rob Portman.
Yeah, and Vanessa's exchange with Portman wasn't the only testy exchange she had. Josh Hawley, another Republican on the Senate panel today, also questioned her, basically voicing what we've seen a continuation of concerns from Republicans as to whether or not the company will give any data to the Chinese government. She has unequivocally continued to say, no, we will not, but she would not go so far as Portman asked to say we will cut off all data. Now, Emily, kind of true to how these hearings seem to be going lately, the conversation has been really wide-ranging outside of just the TikTok context. We have executives from Facebook, from Twitter, and from YouTube there today, and the questions have ranged from responses to some of the allegations we heard this morning that the companies prioritize growth over everything, including user safety, to also getting really specific in the case of Twitter, asking Jay Sullivan over at Twitter whether or not he would commit to saying that the company did not misrepresent information to the FTC. So, Emily, the panel is ongoing as we speak right now, but I'm sure we'll continue to see a range of topics out of this conversation.
Well, David, to that point, maybe even more interesting than hearing the executives testify was hearing the former executives testify at the pre-hearing. What do you make of the concerns that they raised?
Well, it was very meaningful. And it was meaningful not just because they're critics, but because they are such deeply informed critics who are themselves former insiders. So both the former executives from Twitter and from Facebook were among the highest ranking engineering people in the company. In the case of Twitter, he was head of engineering there. And these are people who are now telling the senators that disinformation is not a priority for these companies, that growth, user growth, and user engagement is always prioritized in systems management and design, and that is why the problems exist. And they also were very emphatic that there are tools that could be implemented by government that could require these companies to change that. But they need the incentives from government, and otherwise they're never going to change.
Well, let's talk about that. I mean, there have been hearings like this now for several years, and regulation has yet to catch up. Given the speed at which social media moves and the lack of speed at which regulation moves, how much do you think, David, that this is really going to push the envelope on regulation?
Well, unfortunately, even though the intelligence of questioning at Congress has steadily increased, and I think today's hearings showed that the senators are significantly more informed and probing in an intellectually legitimate way when they talk to these leaders of the tech companies. But in reality, the disagreements between the two parties in terms of what the real harms are, and the general, I think, ambivalence, even among ostensibly angry senators and congresspeople, about whether they really want to rein in these services is going to mean that in the U.S., we're not going to see meaningful regulatory change in the near future. Europe is going to continue to be dramatically in the lead. Now, that's a good thing, at least that somebody's doing it.
Alex, talk to us about the responses from the companies today. I mean, I'm sure by this point, these kind of hearings are par for the course for them. It also seems like their strategy is improving.
It is a little bit, and you do see them at least seeming like they're wanting to play ball to a certain extent. But I did want to highlight something that David just brought up in terms of the tension between the two partisan groups of these senators and how that's manifesting itself and how the companies are coping. One piece that the Republicans in Senate have been really fixated on is this idea of content moderation and what that means. We saw a lot of questioning today from Republican senators trying to get to the bottom of why certain content in regards to some ideas around COVID, in regards to ideas around the election, why that content was removed from the platform and what went into the content moderation choices, and some criticism and allegations from the senators that the companies are operating as kind of partisan. The executives today from YouTube, from Facebook, they were basically able to come in and say, look, we defer to a lot of our third-party fact checkers. Emily, these folks are pretty adept at also sidestepping questions, giving an answer that feels comprehensive. But they did lean in to kind of say, you know, we are trying to work with people who check themselves and who remain bipartisan. So that is an important kind of point in this ongoing political debate as to what happens next out of these hearings. The Republicans seem to be very fixated on some of these issues around content moderation and around China, whereas the Democrats are leaning into some other ideas like, pushing for further controls and questions around the algorithm. So again, these tensions manifesting itself seem to be continuing to raise the level of these conversations, raise the tenor of these conversations, and the quantity of executives going down to Washington. But it has kind of ground some progress to a slower pace than I think some legislators would want.
This, of course, coming a day after Twitter whistleblower and former employee Peter Zatko testified on Capitol Hill. Let's take a quick listen to more of what he had to say, speaking to this question of what is the role of government versus companies when it comes to regulation. Take a listen.
It took me maybe 30 minutes to reach out to an employee and say, what do we know about this person? And then it only took that person maybe 10 minutes to get back to me and said, okay, here's who they are. This is the address where they live. This is where they are physically at this moment. They're on their phone. We know their phone number. We also know all of the other accounts that they've tried to set up on the system and hide. And we know who they are on the other social media platforms as well.